Good morning, everybody. Welcome to today's event, the Bullseye Forecast. It's Saturday, April 15th. You got John Hopkins here, Tom Bulley gonna jump in just a minute. Of course, April 15th is normally the date when taxes are due, but we got the weekend plus another day. So I think it's the 18th, little reprieve. Everybody likes that, little reprieve before you have to send in any money to Uncle Sam. Anyways, welcome to today's event. It's great to have everybody with us. We're going to have a big crowd today. We've got, of course, our wonderful members. Many of you have been with us a long time. Thank you so much. We've also got a lot of new eyeballs. I want to welcome all of you as well. If this is your first time being a part of the Earnings Beast community, we welcome you, and I think you're going to find this to be a very informative session. I do want to remind everybody that every one of our events is recorded. If for some reason you're unable to stick around for the entire event, no problem. We'll make sure you get a recording. It's always our goal to get the recording out the day of the event. If for some reason that doesn't happen, you should have it by tomorrow at the latest. You'll get an email notifying you that the recording is done, and then you'll be able to listen to it anytime you want to. Okay, well, today, really, it's all about outsmarting the market, manipulation for more profitable trades. In this market, of course, any leg up you can get is something you want to take advantage of. So this is something I know Tom is going to get into today. I want to make sure Mr. Bowley's in the house. Good morning, Tom.
I'm sorry, I can't make it today, John.
All right, well, have a good afternoon. I'll take it from here.
Sounds good.
Yeah,
How's
you know,
hopefully everybody's doing well.
Yeah, this is a great, good timing for this. I don't know. I've been watching the market obviously very carefully, like you. And, people I think maybe are a little bit frustrated because the market, it's sort of just hanging out. From my perspective, that's bullish, because what's happened is we've got all these things, I don't know how many, 10 rate increases, a recession potentially looming, or worry about earnings. And yet the market on any pullback keeps getting gobbled up. So I'm feeling actually a little bit confident that as time goes on, we're going to be moving higher. And I know you want to talk about some of that today. I'm just going to go ahead and turn it over to you because I know there's a lot to cover. I will be back in just a little bit to talk to people about a membership special. It's always something we present that is of great value. So I'll do that after a couple of segments, and then we'll repeat it at the end. Make sure everybody gets a chance to get the best deal there is out there. But why don't I go ahead and turn it over to you so we can get this thing going?
Okay, sounds good. Yeah, I mean, I love doing these events for a couple reasons. I mean, number one, I love to educate things that I've researched and found over the years. I like to pass along, try to help people with their lifelong journey, trying to manage their finances and hopefully retire in a more secure fashion. So I think the work I've done and do is certainly rewarded in the end, at least for me. I like to try and, like I said, help folks. And when we go through this process, when I go in and I do one of these events, and I'm kind of referring to this as almost like a little mini market vision event. We do a market vision event first week of January every year. We've done it the last 4 years. And my forecasts have proven to be pretty accurate over the last 4 years. And I know I would say probably 99% of folks in the market think that you can't predict the stock market. You can count me in the 1% or less that believes you can. I don't think you can get everything right. I think the shorter term you go, the harder it gets to predict. Like, I have no idea what's going to happen on Monday or Tuesday or next week. But as you go through this session today, I think you'll start to maybe gain an appreciation for some of the things that you can do and some of the things you can look at to help guide you in the market. Doesn't always give you the perfect answer of what's going to happen in the market, but it'll give you a much, much better understanding of the risks that are involved in the market and what risk you're willing to take. So that's the whole purpose of doing these events. Some say, well, he's just trying to predict the exact where the market's going to be, and where. That's not exactly what we're trying to do here. We're trying to manage risk, and we're trying to look at a lot of factors that you'll never hear on CNBC or any of the media outlets. We're trying to look at things beneath the surface of the S&P 500 to help us understand what's likely to happen, where the probabilities lie. And it's not based on the latest news story. It's not based on, oh my gosh, let's worry about recession. Oh, it's inflation. Oh my gosh, don't fight the Fed. Go away in May. I mean, the media is designed just to brainwash us into thinking that the stock market will never go higher. And yet that's exactly what the stock market does over time. It just keeps going higher and higher and higher. And it's pretty simple. Take our GDP, throw in a few percent for inflation rate, and throw in another few percent for innovation. And that's how we get to a 9% average annual return on the S&P 500 since 1950. It's really, and then when the market goes up too fast, you get pullbacks, and you can blame it on a lot of different things, but you just went up too far, too fast, and the market needs to kind of resume back into reversion to the mean, I guess is what you would say. Anyhow, I got a lot to go over. Let's pull up the agenda and let's get this thing going.
Hey, Tom?
Yeah.
I just want to mention to people, if there's questions, if we have time at the end, we'll try to get to them. So I also will be looking throughout the session if there's something I can answer directly, either about, the questions you might have or the earnings beats in general. I'll be able to answer those. And at the very end, we'll select a few questions and make sure we get to as many as possible. But just so you know, if you put a question in, we're likely not to get to a lot of them till the very end. That's all.
Okay, sounds good. And again, just want to remind anyone coming in late that this session is being recorded. Anyone who's registered for the event will get a copy of the recording so that you can go back and take a look. It'll be time stamped so that you can go back and take a look at certain areas of the market, if you will, or different topics that I discuss. So as we look ahead, here's the agenda. These are the things I'm going to be talking about. I am going to try to keep this as brief as possible. I mean, when you're talking about a forecast, you're going into a lot of different specifics underneath the market. It's not something I can get through in 10 minutes. It's impossible. But, and like I said, there is going to be the recording. So if you have to leave in the middle of it, no problems. You'll be able to go back and review and pick up where you left off. If you do leave and you can't get back in, there could be a capacity issue. So that's another reason why we wanted to make sure that we had a recording. So if you want to make sure you keep your seat for the live session, if you think you want to leave for 15 or 20 minutes, you may or you may not be able to get back in, depending on how full we are at that particular moment. So anyway, I just want to let you know you do have the recording in the event that you have problems with the live webinar, or if you get booted, or if you leave and can't get back in, we got you covered. All right, these are the things we're going to go over today. Technical review. I'm just going to give you a really brief analysis, what I'm seeing with the S&P 500. I'm going to go through best sectors and industry groups. Hopefully, this will be the shortest segment of the agenda topics that you see here, because I just want to go over and highlight what's been working in 2023, what's not, how we can do that very quickly at earningsbeats.com with some of the research and the way we set up chart lists and so forth. Then we're going to jump into the manipulation update. So I've been talking about manipulation in the market for close to a year now. It really started in June of last year. That's when, and there's always manipulation, don't get me wrong. When you've got billions and billions and billions of dollars changing hands each day in the stock market, you don't think there's going to be a little bit of manipulation on Wall Street? If you think there's not any manipulation, you may not enjoy the webinar today. Because I'm telling you, there's plenty of manipulation, and I'll show you how it, the impacts of some of that manipulation. So we'll go through that. I think you're going to find that to be very, very interesting, especially if you're new to Earnings Beats and you have not been paying attention to my work for the last year and a half throughout this cyclical bear market, and now what I believe is a resumption back to the upside. I think you'll find some of the information I show you to be extremely interesting and things that you'll never see on CNBC. I can promise you, they're not trying to educate you and make it so that you fully understand the market, or at least better understand the market. They're all about ratings. They need you to watch their shows so that they can get the big money from the advertisers. So how do they do that? Well, you got to bring in people, it's like Barnum and Bailey circus. You need the Peter Schiffs of the world and the Jeremy Granthams, who always say the sky is falling. And then when it falls once every 20 years, they can say, hey, I was the one that called it. Well, of course you did, because you call them all the time. If you say the market's going to go down every single year, then of course you're going to nail the years when it goes down. Why don't you go back and show the history of Peter Schiff when he's calling every single year for the market to go down? It keeps going higher and higher. Anyway, those of you who know me know I get really animated when it comes to the media. I think the media brainwashes us. I think they take advantage of us. I think where else in the world, and we're going to get started here in just a second, but where else in the world can you have such a perfect conflict of interest where Wall Street, the Goldman Sachs of the world they can manage money for high net worth clients and their own accounts. Then they can parade their analysts out there saying, buy this, sell this, send them on the CNBC, buy this, sell this. And then back at the office, they got market makers providing liquidity. You know what that means? That while the analysts are out there telling all of us to buy and we're buying, their market making units are on the other side of the trades, selling. That's the way the market works. And it's all legal. Anyway, we have to take advantage of that, not be taken advantage of. And that's what I'm hoping you'll get out of some of this that I talk about today. And then we'll go into the sentiment update. I find sentiment to be so important in the long-term direction of the market. I have a couple of indicators, a couple of things I look at on sentiment where I'll call them my speedboat indicators, because these are the ones that can flip, every week or two. And then I've got my freight liners that just kind of give me the overall big picture sentiment that can really drive either a secular bear market or a secular bull market. And so we'll talk a little bit about that and where we stand there. And then I'm going to give you my forecast, Q2 and beyond. Is it the same as what it was back at Market Vision? If you were at Market Vision back in January, I said we'd go up in January. I thought we were going to have a big month in January. I thought February, March would be a little bit not, kind of sideways, maybe down a little bit. And then I thought the rest of the year we were going to go higher. I thought we would have a big move up from March. So is that where I still stand based on things that have happened over the last 3 months? Well, that I'll talk about later. And then we'll wrap up final thoughts and the Q&A. So I'm going to go ahead and get this started. And the first thing I want to do is go through a technical review, and anybody who has followed earnings beats for a long period of time probably can guess the chart I'm going to start with. So we're going to start with my 100-year S&P 500 chart.
Sometimes.
Now, Matt, I think I'm hearing your mic.
Oh, sorry, Bubba.
Yep, no problem. So here we are on the 100-year chart of the S&P 500. And let me ask you one question when you look at this. Would you rather be selling the market or buying the market over the long term? And if you say selling the market, then I can only imagine that you're probably not doing well in the stock market, because over time, the stock market goes up a lot more than it goes down. Since 1950, the S&P 500 has had up years 54 times and down years 18. 54 times the S&P 500 has closed the year with a gain. 18 times it's closed the year with a loss since 1950. That simple math, 75% of the years go higher. So if you know nothing else going into the year, I would hope you'd think that the probability is that we're going to go higher. And that's why I don't understand the Peter Schiffs of the world that are always talking negative, except, hey, if you want to market, Sometimes the best way to get somebody to come in is to scare the heck out of them and to always be bearish, because most individual investors are bearish. They are always seeing negative headlines. They always don't understand how the market can go higher and why we aren't crashing. I mean, like John mentioned at the open, if it's not the pandemic, then it's the inflation, then it's the Fed getting hawkish. Interest rates are going higher. Now we got recession fears. How can the market go up? Oh, QE, might as well throw QE in there. A lot of folks like to say that this whole bull market is artificial, because of the QE. Do you think the smart MBAs on Wall Street don't know the impact of what QE is going to have? They're still buying. Hey, if they're buying, I want to buy. I want to do what those big Wall Street firms are doing. Not what they're saying, what they're doing with their money. And that's how you drowned out all the noise, all the news following the charts. And I'm just telling you, this is the 100-year chart. Does it lie? This is where money has taken us for 100 years. We go through periods where the stock market struggles. Then we go through periods, 1950s and 1960s, secular bull market, kept going up. Now, did we have cyclical bear markets along the way? Yes. 1957 and into, I guess, right into the end of 57. How about 62, 66? All those were drops of 20% or more, but they were within the confines of a long-term uptrend. Secular bull and these pullbacks of 20% or more are cyclical bears. Then you get into these secular bear markets. Secular means long-term. So now we go through a period of about a dozen years where the S&P 500 does nothing. We have a big drop. Then we have a cyclical bull market, another secular bear market drop, cyclical bull market, secular bear market drop. And then finally we come out of it in the early 1980s. And what does that lead us to? 20 years of secular bull market action. 20 years, 1980s and 90s, just like the 1950s and 60s. And then at the end of it, what happens? We go to a secular bear market. 12 years, maybe 13 years here. Big drop, 50%. Cyclical bull market for 3 or 4 years in the middle of it. And then another big drop. I think that was 59%. And then we start to rally again. And it's not until we finally break out above these prior highs that we start the next secular bull market. We've been in this since 2013. So it's 2023, 10 years. We've had cyclical bear markets along the way. 2018, the trade war, cyclical bear market. The pandemic, everybody wanted to call that the Great Depression 2.0 back in March. Remember? A lot of folks feeling a lot of despair back then. Big drop, down 35, 36% in a month. I wrote right in the middle of it, it was a healthcare crisis, not a financial crisis. And we went right back up and resumed the secular bull market. Now, the problem was when we got to the end of 2022, and I'll talk about more of this with sentiment, but just take a look. This is first of all, this is a monthly chart. So down here at the bottom, I have a 12-month rate of change. And so this gives you an idea of how much we've gone up, over a period of time. In this case, 1 year. And look at these highs. Anytime you get up to 50% in a year, remember, we've averaged going up on the S&P 500 9% a year. So you've got to have perspective when you evaluate the stock market. When you go up 50%, when you have a 12-month rate of change that hits 50%, you're doing almost 6 times the normal what you would do in a year. So if you're going to end up doing 9% over time, and you do 50% in 1 year, you're going to at some point have a reversion to the mean. You're going to have to go through periods where the market doesn't do well. At the end of 2022, everyone thought the market was an ATM machine. You just buy a stock, somebody posts it over on Wall Street Bets and the all the meme stocks taking off. It didn't matter what you bought. Just buy it. Somebody posted about it. That means it's got to go up, right? And it did for a while. That worked great until we got so many people into the market and so much money coming into the market, it couldn't go higher anymore. That's what happens. You've got to keep perspective at all times, not just on the bullish side, not just on the bearish side, at all times. You have to be aware of what's been taking place in the market. In order to forecast the future, you have to know what's happened in the past. That's part of it. Now, when you go through these secular bear markets, I want you just to notice a couple things that typically happen. These are the long-term bear markets. Monthly RSI goes below 40. RSI is just a momentum indicator. It's the relative strength index. Don't get confused with when I talk about relative strength of sectors versus, intermarket relationships. That's a different relative strength. This relative strength index is basically just looking at the last 14 periods. So in this case, it's a monthly chart. So it's looking at the last 14 months. And normally in a secular bull market, the RSI rarely drops below 40. So here's with secular bull market. Look at the RSI. We get down to about 40. We had 2 slight breaches of 40, but other than that, for 20 years, we stayed above 40. During secular bear markets, look at us drop back in the 30s, 1930s, 1940s, 1970s, 2002, 2003, and then 2008, 2009. All of those, we saw the RSI, monthly RSI dipping well below 40. In many cases, well below 30, occasionally even below 20. You need a lot of selling for a long period of time to have a secular bear market. Every time the market goes down, everybody wants to start screaming, oh, this is it. End of the secular bull market. We're going down. About 80% of the time, they're wrong. 11 of the last 14 bear markets have been cyclical in nature, short term. Only 3 in the last 50 or 75 years, 73 years, whatever, have been this big drop. 1 occurred in the 1970s right here, and 2 in the 2000s, 2000 to 2003 or 2002, and then 2007 to 2009. Those are the only 3 secular bear markets in the last 73 years. And yet everybody, every time the market drops, wants to call another one. And all I can say is I wish you the best of luck. 80% of them, 11 out of 14 of them, have been cyclical in nature. Short-term pullbacks in long-term uptrends. Perspective. It's all about perspective. It's about odds. It's about managing risk. Check out the monthly PPO. Secular bull markets, always positive, always positive, always positive. Secular bear markets, the monthly PPO goes negative. And the PPO, for those of you maybe who don't follow technical analysis, it's simply another momentum indicator. It's an oscillator. It's a price percentage oscillator. And it's looking at the 12-period exponential moving average and the 26-period exponential moving average. And this is a monthly chart. So it's a 12-month and a 26-month exponential moving average. When the long-term moving average drops below the short-term moving average, we go negative. That means a 26-month moving average has to go below the 12-month. That's when it goes negative. That's when you have secular bear markets. In secular bull markets, we don't see weakness last long enough for the 26 period to get below the 12 period, which is why when we go through these weak periods during a secular bear market, or excuse me, secular bull market, notice the PPO gets down to the center line and then hooks back up. See it every time. In a secular bear market, there's no hooking. We go straight below into red territory. Every one of these. Do you see any hooks? I don't see the hooks until we get way down in negative territory. I mean, I think it's pretty clear. Look at what we're doing right now. Coming down above zero and we're hooking back up. None of these did that. None of them. No head fakes. It's hard to do a head fake on a monthly chart because it just takes too long. You see a lot of head fakes on a daily chart, but not on a monthly chart. So again, we're starting to hook up above the zero line, which is exactly what I expected. I don't really want to spend a whole lot more time, but what I will say is that when the bull market here broke out above these double tops and moved to the upside to this 0.1 before the cyclical bear market kicked in last year, this is how all of the ETFs performed. The major sector ETFs, technology, discretionary, communication services, healthcare, financials, and so on. I also put the NASDAQ in here and I put the S&P 500. Now, this is important because during secular bull market advances, I want you to look at what performs well. Technology, discretionary, consumer discretionary is XLY. Communication services is XLC. That's home of the internet stocks. You got, retailers in the XLY. You've got autos in the XLY. You've got home builders in the XLY. Technology, you've got semiconductors, you've got software, you've got computer hardware, you've got renewable energy. Those are all things in the XLK. These are all high growth areas. And so when you get in a secular bull market, we look for leadership in those areas. And keep this in mind because I'll be talking about this throughout today's session. Anytime you've got money rotating into these high growth areas, Wall Street is telling us that we should be expecting good things ahead. When we start to see money rotating out of these groups, that's when we need to be a little bit more cautious, generally speaking. So let's keep that in mind as we keep going. But this is kind of a big long-term chart that I always go back to and look at. I don't have to do it every day because obviously it's not going to change much every day. But every few months, 6 months, a year, probably a good idea to pull it out, just see, make sure we kind of understand what's going on. And it helps in the short term, kind of fitting in to what we expect based on what we're seeing in the long term. Anyway, that's a chart I always like to start with. So hopefully that gives you a little bit of perspective of where we've been and how the market works from a big picture perspective. Now I'm going to go down to a 5-year weekly chart. And I just want to show you the S&P 500. So here's the S&P. We talked about the PPO on the monthly chart. We talked about the RSI on the monthly chart. So let's just go down to the weekly chart. Let's just show kind of where we are right now. So over the last 5 years, you can see this was the 2018 trade war cyclical bear market that lasted 3 months. And during that period, you can see that the weekly RSI only got back up to 50, never really got above 50. In the pandemic, we never really had any bounces. So we just had one big drop and then we started coming right back up. This cyclical bear market that we were in 2022, and I believe it's cyclical, meaning that it's already ended. I don't believe we see a bottom below that September low. My original bottom call was right here in June of 2022. Late September, I said, hey, you're getting a second chance. And we actually, in early October, I think we spent 5 trading days where we actually closed below that June low. So it wasn't much. I think that June low was a pretty good call, but certainly the double bottom, I think, sealed the deal. I think now we're in an uptrend. And looking at the way the PPOs and the RSIs are trading right now, I think it looks like a bull market advance. Could it turn lower? Of course, the market can do anything it wants. We've got to be prepared to be wrong. But I'm not going into this thing thinking I'm wrong. I will go in with my conviction until the market tells me otherwise, based on everything I'm seeing, not based on what I'm seeing in the news. I mean, we've been rallying. How could we possibly be rallying if the market listened to the news? The last 6 months, the news has been nothing but horrific. Whether you want to talk about inflation, whether you want to talk about the Fed, the fact rates have been going up so fast, the recession fears, everything has been negative. How does the market go up? Well, market prices things in advance. Why do you think we had a cyclical bear market in the first place? The stock market doesn't wait for the news to come out to start going down. Stock market goes down in advance of the news. Stock market is the leading economic indicator. It is probably the best leading economic indicator. So right now, what the stock market is doing is forecasting what the stock market sees 6 to 9 months down the road, maybe a year down the road. It's not forecasting what we're seeing right now or what all the talking heads want to talk about. Ignore that. Follow what the stock market is telling you. So here's the weekly chart. When the PPO, weekly PPO is positive and prices are going up and the RSI is within the 40 to 70 range, notice during these bear market periods, cyclical bear markets, RSI weekly goes down to 30. Here it went down to low 20s. Here it went down to almost 30. Where were the highs? Here, never above 60. Here, we never even got a bounce. It was just a one steady drop. Here, never above 50. 50 to 60 marks resistance. When you're in a bull market phase, 40 to 50 marks support. Look at the RSI come down into the 40s and 50s. Here we get down to 50, basically, not really much below 50. Recently, we've been below, in that 40 to 50 range. Right now, we're sitting at 56. Now, we haven't gotten back above 60, so that would be the next thing I would look for to confirm the move to the upside, is we want to see that S&P RSI, the weekly RSI, move up. Now, I try to look at both sides of the picture. Listen, I was bearish, very bearish, cautious to start the beginning of 2022. Right here, I was very cautious. As we started breaking down, I was turning very bearish. And essentially on all of these rallies, I was saying, don't trust it, don't trust it, don't trust it. Because every time we set a new low, my signals were saying, we're going to keep going lower. So when we got the rallies, I was expecting them to be short-lived and we'd go back down again. This was the first time that I started to change my tune and said, hey, things are changing. And I will, be going over some of the signals and things that I saw in just a little bit. But there are a lot of technicians, a lot of folks that kind of forget what they were thinking when the market was topping. I know I read a lot of folks saying, oh yeah, we thought it, we said it was a bear market. Well, they said it was a bear market after we started breaking down and we'd been down for 3 or 4 months and already, 10, 15% lower. And yeah, then they started getting bearish. And then at the end, they're like, yep, that's what I said. It was, called it. The real key is calling it up here. This is where you want to call it. Not after it's, what good's it do you after your portfolio is down 20%? I've had folks say, well, you don't want to get out until the technicals break down and tell you to get out. Well, if you wait until the technicals break down, which I'm assuming is this price support over here, you're already down from 4,800 down to, below 4,200. You're already down 15%. Your portfolio is down 50. It's harder to get out after you're down 15%. Mentally, it's exhausting because you're worried, oh, if I get out, then what if it goes back up again? And so you're like, oh, I'll buy and hold. I'll just keep. And then it goes down again, goes down again, goes down again until it finally wears you out. And you're like, I can't let it go to zero. I'm getting out. And then you start buying into everybody that talks negative about the market. It's called confirmation bias. You want to feel right about selling and about being bearish the market. So you want to tune in to anybody that's bearish. Get a little cheerleading going. You got to think on your own. You cannot get into that mindset. So here was the move down. I'm going to show you a couple things. Right here. When did we top? Right at the end of 2021. Here was my article I wrote over at Stock Charts. December 31st, New Year's Eve, 8 o'clock. Yes, I have no life. Should have been out at a New Year's Eve party. And what am I doing? I'm studying the stock market because that's what I do. It's my passion. I love to do it. So I literally wrote an article and published it while everybody else was out celebrating New Year's Eve. And when they woke up with their hangover on Saturday, this is the article that they got to read. And I went down here to the bottom. First of all, I was pointing out the growth stocks were starting 2021. Growth stocks were getting hit, especially small caps. But the final straw, one of the final straws, one of the final nails in the coffin was this table that I put in here for the month of December. And I'll show you what, in December in just a minute. We'll go back to the chart. But December, we had our final leg up. right? Put in the final high before the bear market kicked in. Look at the monthly sector summary and what led the market to the upside. Consumer staples up 10% in December. These are defensive stocks. Real estate, defensive stocks up 10%. Utilities, defensive stocks up 9.6%. Healthcare, defensive stocks up 9%. Come down here to the bottom. The three most aggressive groups. Remember I showed you the sectors that were leading since 2013 on that first 100-year chart? And I said technology, consumer discretionary was second, communication services was third. As the market was putting in its final high, look at how these groups were performing. They were moving up, but they were way underperforming defensive stocks. Wall Street may have been on CNBC saying, here we go, all-time highs, let's do some cheerleading. But behind the scenes, under the surface of the market, this is what we were getting. Rotation out of aggressive areas and into defensive areas to lead the final push to the upside. And so I even said here, I was just talking about the fact the market was going up or whatever, and I said, but there's been one major change this time. Defensive sectors have led the rally, and that's never a good thing. So I kind of summarized it right here by saying defensive groups frequently lead when the stock market is weak. That's what we expect. When the market's going down, defensive stocks lead. That's just because when you're going down, you sell the high growth stocks and you hold on to more value oriented stocks, or you rotate a little bit. So they don't go down as much. Their earnings are a little bit more predictable. They kind of hold their value. But I went on to say, rarely do they lead when the stock market is strong. Wall Street is losing confidence in this bull market rally, and so should we. That was December 31st. And if you look at the chart, that was right here at the top. Then you get all the way down the bottom. Now I'm starting to see more and more technicians. Maybe it's, I don't know what the ratio is, but there's more people coming out and saying, well, things are starting to look better. Market is starting to look a little bit better now. I don't know, maybe you might want to put some capital to work. This is where we put our capital to work. I mean, you can go back and listen to my videos. Here was my June 16th, 2022 video, right at that market bottom. I'm calling the bottom in the S&P 500. I don't know how I could have been any more clear. Now, if you went into the video and listened to the video, what I was really saying was the risks have completely reversed. It's not that I know for sure the stock market's going to bottom. Nobody knows that. But what I do know is that a lot of the risks of being long had evaporated. All those risks I had seen back in December at the end of the year had evaporated. And I went back in September and doubled down. There it is, September 27th, 22. I'm calling this market bottom 2.0. Look at the chart. There are the two videos. Well, actually, this one, the black arrow would have been right here at the end of September. I think it was, I said September 27th. So the market did go down just a little bit further, but we've been rallying since. I mean, go on to the next chart. I think I have it on the next chart. This is no, this is a different chart. Let me see. Well, let's go ahead and just keep moving anyway. This will help to explain a little bit about what I was seeing in the market and why I called these things when nobody else was talking about it. Number one, Wall Street isn't going to tell, I know Wall Street knows about it because their money is reflecting it. They're getting out of certain areas of the market. Look at the S&P 500 as we went into the last part of the year. New high, right? Indisputable, new high. Look at the QQQ relative to the spider. This is the NASDAQ 100 ETF relative to the S&P 500 ETF. Now, why would I look at this? Well, for one, the QQQ has very little financial exposure. and it is much, much more geared toward growth stocks than the S&P 500. Now, both of these ETFs, excuse me, both of these have stocks like Microsoft and Apple and NVIDIA and Tesla. They both hold those stocks, but the QQQ holds a higher percentage of them. So the QQQ is just more growth flavored, and the S&P 500 has many of those growth stocks, but it has more value oriented stocks in it. So by looking at the ratio of these two ETFs, you can get a flavor of whether or not the stock market is in risk on environment. And when they're in risk on environment, I want to be long. That's when the market is saying, hey, everything looks good, full speed ahead. So when this is going up, when this ratio is going up, and some of the others I show you, when they're going up, that's telling you, hey, you want to be in the market. When they're going down, that can be a problem. So anyway, we go into the end of 2021. S&P makes its final high. I think it was January 3rd. I think was the high close, January 3rd, 2022. But here was the QQQ and the spider rolling over. Here was my favorite ratio, XLY, XLP, consumer discretionary versus consumer staples. I'll probably talk about this a few times throughout the session. The reason that this is important is you have to understand that the GDP, our gross domestic product, is estimated to be about 2/3 consumer spending. That's what drives our GDP, consumer spending. So doesn't it just make common sense that if we look at whether consumer discretionary is doing better or consumer staples is doing better, doesn't that kind of tell us a little sense about risk on, risk off? Now, consumer discretionary, this is a sector that houses a lot of different companies that sell us the things we want. Consumer staples, on the other hand, are companies that sell us the things we need. Okay? So think of, when you're feeling really good about things, I don't know, maybe your 401k has been doing well, and maybe your job just got a promotion, got a pay raise. I don't know, whatever. You're just feeling better about things financially. You probably are thinking about, okay, I'm going to stop by Starbucks. I'm going to get that latte I wanted. Or, maybe stop over at Chick-fil-A or go out to a restaurant for dinner. Maybe I'll think about getting that new car. My car, it's not that bad, but hey, it'd be nice to have a new one. Or what about, maybe I've been in this apartment. I want to go out and buy a house. Or maybe I'm in a house and I want to buy a bigger house. All of these decisions are wants, not needs. Needs are going out and buying toothpaste, deodorant, soap, food. These are things that we need to live. I mean, if you're starting to feel bad about the economy, and maybe your pay hike was only 2% and you wanted it to be 8%, and you're just not feeling very good about things. Maybe your 401k has been going down, market's not doing so well. You might think, well, I'm going to pass on that Starbucks latte. But are you going to say the same thing when you start to run out of toothpaste? Are you going to say, you know what? I've had a pretty rough year in the market. I think I'm going to stop brushing my teeth. I don't think I hope that doesn't take place. If you're not brushing your teeth because the market's gone down in 2022, or you're not, using deodorant, I can only say I'm glad this is an online webinar and not an in-person one, because that would be pretty disgusting. People will keep buying what they need. That's why the earnings of companies like Procter & Gamble and Colgate and those companies, their earnings tend to be pretty predictable. And so even during this big drop that we've seen in the stock market, consumer staples have actually held up pretty well. XLP, if you look at their chart, they don't really go up a lot when the market's rising, and they don't go down a lot when the market's dropping. Why? Because people need their products in any market. I have never once said, oh my gosh, we're having a big rally in the market. I'm going to go out and I'm going to get 5 years worth of toothpaste. I mean, I'm going to start brushing my teeth 4 times a day instead of 2. I've never done that based on what's going on in my life. Your wants are your wants, and you're going to want things more when things are going well. And you're not going to, you're not going to satisfy those wants necessarily. Some of you, or some of us anyway, when we're not doing well, we don't feel well about things, but hopefully we're going to always get that toothpaste. I know I went into a long dissertation here, but this is such a big ratio to follow. And one other thing that some folks will say is, yeah, but the XLY is, it's 40-45% Amazon and Tesla. It's two companies. And my response is, yeah, they're probably two of the most influential companies in the world. Some people say, well, let's do the equal weight. I'm like, really? So you want to equal weight. So Amazon, who employs hundreds of thousands of people around the globe and is part of our everyday life, you think that they should be weighted the same as some obscure restaurant that maybe has 10 million a year in sales? You think that those two companies should be weighted the same? Do you think they have the same impact on our economy? I can promise you, if Amazon's doing poorly and they start laying off, which they have, but if they start laying off people, it's going to have a much bigger toll on what happens in the stock market than if that pizza place decides to lay off a couple drivers. It's all about perspective. Yeah, Amazon's a big company. I want to know what's going on with Amazon. I want to know what's going on with Tesla. These are the companies that drive the S&P 500. They're the market cap leaders. Some of them, a couple of them. Apple's the big one. You got Apple, you got Microsoft, Amazon, Google, NVIDIA, Tesla, all those. But it's, S&P 500 is market cap weighted. Why wouldn't you be interested in seeing what's going on with the high market cap companies? I don't understand the whole thing. And if you look at the XLY versus the XLP, it's so much better at predicting the market going forward than if you look at the equal weighted. And I forget what the equal weighted are. It's like RHS, RS, something. I don't know. But you could look it up. You can probably just type in up here equal weight and get that. But anyway, XLY, XLP is really important. When we got to June or May, and we started to, and we went to a much, much lower low in June, right here. I mean, we took another 10% drop here. And we started to see the QQQ SPY ratio start to flatten. You can see the XLY, XLP actually started to roll over, turn back up. Growth stocks, large cap growth, actually from May to June, you can see we actually started to turn up. Over the next few months, mid cap growth, small cap growth, all of these versus value started to turn back up. So the signals that they were giving us before was money was rotating out of these groups while the S&P was going up. That was a good reason to be cautious. But now, as we keep going down on the S&P, we're starting to get some of the signals going the other way. And it really turned here in 2023. Look at these ratios in 2023. Look at the S&P 500. It looks okay. I mean, we went up, we had a pullback, held the prior low. Now we're up here challenging the recent high. But look at the rotation that's taking place. The S&P is not soaring, but the QQQ is relative to the S&P. The XLY versus the XLP is moving up quite a bit, although last couple of months rolling back over. This is still one thing that I would maybe put into the bearish column. It's not doing quite as well as I'd like to see. But I got another chart I'll show you on the XLY, XLP later that I think will help to explain some of the manipulation that's taken place. Then you've got the growth, large cap growth versus large cap value moving up. Mid cap growth versus mid cap value ratio moving up. Small cap growth versus small cap value. Everything's turning up. Money is rotating into risk on areas of the market. This is what you want to see. This is Wall Street manipulating. We are seeing gap downs. We're seeing sell-offs in the morning, and we are seeing buying all the rest of the day. And I'll bring that crystal clear to you when I talk about manipulation later. Anyway, so that's a chart worth watching, right? This was back in 2006 to 2010. Same chart, by the way, exactly same chart I just showed you. Only the dates are different. This was the end of the bear market in 2008 into 2009. See prices go down. S&P 500 new low. Everything on CNBC, I can guarantee you, was incredibly bearish. Here we go down again. Market's going to zero. Blah blah blah. And as all that was taking place, wait a minute. Money is rotating big time into the QQQ versus Spider. XLY XLP ratio turned up on this low. Sound familiar? The growth, large cap growth versus large cap value takes off. Mid cap growth versus mid cap value takes off, and the same thing for small cap. Now, we did weaken a little bit later, and I'll tell you, part of the problem, and if you look throughout the bear market here, by the way, you'll see that a lot of these growth ratios did pretty well. Not the XLY XLP. That actually nailed. Look at the top. Look at the S&P 500, these two highs right here. From here, higher high, higher high. From here, lower high, lower high. You see money rotating toward consumer staples? Money was getting out of consumer discretionary. During 2007, rotation was taking place. And then the drop. The market doesn't just drop randomly. Wall Street gets out first. And then once they get out, then they can set fire to the theater and watch everybody scramble to try and hit the exit. So part of the reason when you see these other ratios going up, you'd probably say, well, Tom, you know, what's going on here? All the growth was going up. Look at this new high in growth. Wouldn't that be a bullish signal? Well, you have to understand what was driving the S&P 500. Every bear market's different. 2007 to 2009 was all about one thing, financial crisis. Remember, QQQ doesn't have financial representation, very little. So it wasn't impacted by the crisis. So yeah, growth stocks went down. Everything went down during the bear market, but the relative strength stayed up because it was the financials that were getting hammered. Also, if you don't know, from about the middle of 2008 to the beginning part of 2009, crude oil dropped from $150 a barrel to $35. That is a true statement. $150 a barrel right here to $35 a barrel at the beginning of 2009. Energy's value stocks. Energy's heavily, well, not heavily represented, but more represented in the S&P than it is in the NASDAQ. So a couple areas of the market that were driving the 2007 to 2009 bear market were impacting the spider and value stocks more so than the QQQ and growth stocks. That's why growth on a relative basis looks pretty good. The XLY XLP, though, has proven over time to me to be the best ratio to watch. I think it is. It's my number one go-to, and I'll show you correlation in a little while that helps to explain it. All right, next up here, this is 1999 actually, to 2003. Same chart. I'm not making this stuff up. Look at the S&P, double top. Looks like we were just getting ready to break out in August of 2000. Remember all that late 1990s? We were going crazy to the upside. There you go. We're ready to make another breakout, right? Well, QQQ versus Spider was dropping. And now this bear market, by the way, was led by growth and by QQQ. This was the dot-com bubble, remember? This wasn't a financial crisis. Everything went down, but this was led by technology. So anyhow, that went down. But look at, before we hit this top right here, the double top, look at what the XLY XLP was doing. Completely falling apart. And by the time we actually began to break down in October of 2000, I mean, that's when we started to take out these prior lows, the XLY XLP was at a multi-year low. Money was pouring into staples and away from the discretionary stocks. And then as we kept going lower and lower, look at the bottoms on the XLY XLP. Each one of these was telling us we were getting closer and closer. And by the time we actually bottomed right here in March of 2003, the XLY, XLP was breaking out down near a bottom. It was almost at the bottom of a 2.5 year nasty, one of the worst bear markets we've ever had. And the XLY, XLP ratio was sitting right on the cusp of a 2.5, 3 year relative high. Money rotates. Wall Street was getting theirs before you were getting yours. They're not going to be left behind. They're going to make money, which is why I always talk to our Earnings Beats members about trying to do whatever the market makers are doing. Market makers are like bookies. They've got the big Wall Street firms have market making units. And when you look at a stock and there's a bid and the ask, the market makers, if you want to buy the stock, you buy at the ask. If you want to sell, you sell at the bid. And they take that spread. And that spread many years ago used to be a lot. And that's how they used to make their money. There wasn't much volume, not as much volume in the market back then. And the spreads were wider. Well, in about 1999 or 2000, we went to the decimal system and spreads started dropping. We went more into like online trading. And so people could execute trades much cheaper, not only in the fees that were being charged, but also in the spreads that they had to pay. So market makers were making less and less money from the spreads and more from trading. They get the order flow. They see everything before we do. And it never hurts when you've got your analysts going online somewhere, going to CNBC saying, hey, buy, buy, buy. Meanwhile, everybody buys listening to the analyst, and then their market making unit back at the office is selling. And you still don't think there's manipulation that might be taking place in the market? Wait until I go through the manipulation segment in a little bit. Anyway, again, that XLY XLP ratio to me is really almost spot on. And I'll show you correlation a little bit later to help explain that. So here is the 6-month rate of change, or basically all the way back to the low in October. The S&P 500, since that low in October, is up 12.75%. The NASDAQ's up 18.5%. So money is rotating back into risk-on areas of the market. And you have to realize at the beginning of the year, if you look from the low in October to the end of the year, the NASDAQ hadn't gone anywhere. The S&P had. It's all been this year. That's where the money has really been coming in. So that takes me to the next segment, which is best sectors and industry groups. So what I want to do here for this segment is I just want to pull up, we send out a relative strength chart list to our members at Earnings Beats. And if you're also a member at Stock Charts, we have no financial affiliation with Stock Charts. It's just simply the charting platform that I use and that I've learned on and that I teach from. So if you happen to be a Stock Charts member, there are ways that we provide chart lists, which is basically stored charts, many of them in one chart list. You can get up to 1,000 in a chart list. And we can give our members a link. And if they're signed into their Stock Charts account and they click on our link and use our password, they can take all of our work and drop it right into their account on this platform. Now, if you use a different platform than Stock Charts, you can still get information. I know we do a lot of stuff with Trading Station, I think, and some other platforms that you can still get information. We can send you an Excel spreadsheet effectively, I think, with a lot of the symbols and so forth. So you can still have that information for your other platform. You would just have to contact us at Earnings Beats and we'll see what we can do to help you. But if I go in, this is one of the chart lists that we do for members. This is a very simple one. This is just relative strength of the sectors. And it's just 11 charts. It's 11 sectors. There are 11 sector charts. And this just tells me, okay, what's going on with technology relative to the S&P 500. This isn't telling me that technology is going up. I know technology is going up. Down here, I've got the absolute chart telling me that it's going up. But if you look at this, technology is nowhere near where it was back at the end of 2021, right? The XLK was up at over 170. Now we're below 150. So we still got a lot of ways to go. But look at on a relative basis, we actually set a new high. That's pretty impressive. Hold on one second. Okay, sorry about that. That new 50 or actually all-time relative high is pretty impressive. Doesn't that kind of give us a sense the market is rotating into a more aggressive area? Why would technology, everybody's talking about a recession ahead. Oh my God, we're going to have a recession. It could be bad. It's going to be this. It's going to be that. They also said 6 months ago, don't fight the Fed. I had to point out multiple instances where the stock market goes up while the Fed's raising rates. So where do you get this, don't fight the Fed? That's a catchy little phrase that the media loves. Why? Because if you put it in your headlines, you'll get a lot more clicks, right? Just like go away in May. I can prove that theory not completely wrong. There are a couple of elements that are correct about it, but you don't want to go away in May. I can promise you, you don't want to go away in May. But that's a catchy headline that a lot of people now are used to. And so the end of April, if you want some clicks, you just put that little reminder out there for everybody. Be careful. Oh my gosh, we got a recession coming and it's go away in May. So there you go. You got a lot more clicks. But let me ask you this, because the stock market for me is a lot common sense. When you start looking at intermarket relationships, the money, I want to follow where the money is going. I don't want to follow the lips on CNBC. That's going to take me down the wrong path every time. Don't care. I don't care what anybody's saying on CNBC. I get member questions sometimes. Well, I saw this on CNBC, or I saw this on YouTube, or I saw this. What do you think of this? I can tell you what I think about it. Throw it out. Follow the charts. This is telling me money is pouring into technology right now. Why in the heck would money pour into technology if we were going to see a major recession ahead? That means profits go down. If profits go down, forecasts go down. If forecasts go down, valuations go down. Why would Wall Street want to be in? Why would the three sectors that are higher this year, the three aggressive sectors, they're the only ones up right now year to date? It's not that the other ones are bad. It's just that when those three aggressive groups are going up, they make up probably 45% of the S&P 500. So if they're going up, by default, just about everything else has to be going down on a relative basis. You can't have all 11 sectors going up relative to the S&P 500. That if something's going up relative to the S&P 500, other areas have to be going down, because the net of it all has to be the S&P 500, right? So look at the relative strength in technology. Now, again, discretionary, I'm going to show you this chart. This one still gives me a little heartache at night. Been going down. We saw the huge rally in January going down. It started to turn up again here in April. This is one that I want to see continue to go up. I think this is probably going to be one of the keys in the balance of 2023. Where does this XLY go relative to the S&P 500? Could we keep going up without discretionary? I guess we could. But again, I'm going to show you the correlation of the XLY versus the XLP is really strong, positive correlation. All right, next up, let's take a look at XLC. The worst performing sector over probably a 12 to 15 month period. Relative strength fell apart. These stocks got killed in 2020, at the end of 2021 and into 2022. You want to know why? Because the Fed went for many months saying that inflation was transitory. Remember? They kept saying it was transitory. It's going to be short-term, temporary. They're not going to raise rates, blah, blah, blah. Once the stock market began realizing that the Fed was changing its tune and was going to start raising rates, they started getting out. Now, the big rate hikes didn't start until May, June. I Can't remember the first 75 basis point hike. I think it was in June, might have been May. But anyway, that's when the rate hike started. But the stock market prices things in 6 to 9 months ahead. If rates are going to go up, valuations of high growth stocks are going to go down. If everything else is equal, I'm a former practicing CPA. I was in public accounting for 20 years. I was the head of our firm's accounting and auditing committee. I audited banks. I audited manufacturers. I audited retailers. I audited service companies. I understand the fundamental side. When you have companies, I did valuations, and when you have companies that are expecting either lower profits or if you're expecting higher interest rates, both of those take big hits into valuations. That's why when a lot of companies come out and they lower their forecast, valuation models show lower valuations. If you lower your forecast, and I mean, I guess if you can convince Wall Street it's just for one quarter, it's just going to be the next quarter, then maybe they don't lower that future forecast. But if you come out and you say, hey, we're not going to meet our numbers for next quarter, and we're not going to meet our numbers for this year or next year, that stock is normally going to get hit pretty hard. And it's because valuations immediately drop. Same thing for when interest rates go up, because future earnings get discounted back at current rates of interest. So when interest rates are going up, it makes future earnings less valuable. When interest rates are going down, it makes those future earnings more valuable. So now let's think about communication services with that in mind. We're going down. These are the internet stocks, media agencies, some of the broadcasting, entertainment stocks. They are starting to get hit. Why? Because the market is beginning to anticipate the higher interest rates. When we actually got the higher interest rates, we went through we're still getting some, we're still getting a little bit, but now we're starting to see the opposite. We're starting to see money rotating into these groups. So why would they do that? My opinion, the stock market's forecasting rate decreases later this year, maybe the beginning of next year, but I think they're going to probably happen late this year. Inflation's going to be gone. We are going to see some economic signs. Well, I think we're already seeing them. Initial jobless claims have gone back up, much higher than they've been recently. The jobs number just came out, was below expectation. It's still positive, but it was below expectation. And the Fed has said that we're expecting unemployment to go up. So but the market knows all that already. The market is looking at, what does that mean? What is going to happen? And what's going to happen is that we are going to slow, and the Fed is going to start lowering rates. And if they do that, Wall Street wants to be in growth stocks. Just like back last December or December 2021, they wanted to be out of growth stocks. And they started selling growth stocks. Wait until I get the manipulation. I'm going to be into that here in just a few minutes. But that is what, you've got to be aware of, is Wall Street does things ahead of time. Don't listen to the news. Please don't listen to the news. Try your hard. I go out and I meet with friends sometimes, and I feel, stupid sometimes in terms of current events, because people start talking about stuff that they saw in the news. And I swear, because of my involvement in the stock market, I have completely watched news, any kind of news. I just don't like news. For one thing, back when Walter Cronkite was doing the news, it was news. Now, with social media and all the news, quote unquote, that's going around everywhere, you don't know what news is. I don't know if it's news or an opinion. And all that does is just messes me up with the stock market. I look at the charts. I don't care what news is out there. I can tell you where the money's going. And right now, the money is rotating into the offensive areas of the market. Risk on. You don't do that if the market's going to drop based on some future recession. If we have one, we may get that soft landing where it slows down, but we stay positive on GDP. Maybe we have a slight, mild recession. That's what the market is telling me right now, not what I'm hearing on CNBC or in news stories. That's what the stock market's telling me. We might have a little bit of something down the road, but we want to be in growth. And if Wall Street, the big money wants to be in growth, then I want to be in growth. I've told members, I think the QQQ is the play. So far this year, in 2023, the QQQ is blowing away. The S&P 500 growth is killing value. Anyway, I'm going to go ahead and just move on and just show you relative strength industry groups. So this is a little bit more of a list. 104 industry groups, all in one chart list. And what you can do at Stock Charts is I can pull up this whole chart list. I'm going to view all, and then I'm going to hit summary. And this gives me every one of these industry groups, but it's relative strength. So it's not just the industry group, it's the industry group divided by the S&P 500. That's what I'm tracking. And here, this is for intraday. So this is Friday's action. The banks were the best performing industry group by far. Of course, we've had JP Morgan, Citigroup, Wells Fargo, PNC. I think they all reported. Next week, we'll have a bunch more banks reporting. And we got positive reactions out of the banks. And so they led. Truckers. Did you know truckers were the number 2 group on Friday? How about hotels? Did you know hotels were number 3? That was an XLY. I've got them numbered in here. All the 002s will be XLY industry groups. All the 001 are technology. So I'm looking down here to find the first technology. And there it is. Semiconductors. They actually went up a little bit relative to the S&P 500. But anyway, I've got all the industry groups numbered within their sector. Okay. But I can glance at this and I can just see which sectors are leading. So you got a financial there, industrials, financial, couple discretionary, communication services, industrial, discretionary, industrial, discretionary, financial. There's staples. We don't get to the first defensive oriented group until all the way down here. All right. All these others are aggressive, risk on. So that was Friday. But what if we wanted to see, okay, what's happened over the last week? Now you got a different list. Now you got materials up top. You got staples second, then industrials, discretionary, industrials, discretionary. But what if I said year to date? What's been leading since the beginning of this year? Now look what's up there. Discretionary, technology, communication services, technology, discretionary, discretionary, technology, discretionary, communication services, industrials, materials. We don't get to anything other than risk on until all the way down here. Money is flowing into these growth areas. Look at the groups that are crushing the S&P 500. Autos, renewable energy, internet stocks, semiconductors, travel and tourism, computer hardware, gambling, software, home builders, broadline retail. Folks, I'm not making this up. This is the money. This is following the money. All of these very aggressive groups. So you've got news coming in on the one hand saying, oh, we got a recession coming. And you got all these folks still really bearish. And then I'm looking at the money saying, okay, be bearish if you want. I can tell you what Wall Street's doing, and they're not being defensive. Excuse me. 1 second. All right. How about the bottom? Might as well. Last thing we'll do here with the second part of this group sector analysis is we will sort by the percentage change, go the other way. We're going to take a break here in about 2 minutes. So here is, look at now on the downside. So you got financials, and then there's energy, financials, materials, real estate, financials, materials, real estate, financials, industrials, healthcare. There's your first discretionary. Energy, real estate, materials, financials. These are all areas that typically do well when value is favored, when you're more into a value-oriented market. And since the beginning of the year, that's what you see. Almost nothing of, you know, from a risk on perspective, almost nothing at the bottom. So you can just look at this and for the last 3 months, see rotation. Now, if I was looking at this, the market was rallying a little bit and it was rallying because of value oriented stocks and growth was lagging. That would tell me that would be giving me a different story. But there is no reason. Somebody wrote in to me and said, oh, it's short covering. I'm like, really? Really? A 26% advance in the NASDAQ, and the fact that we are now well above where we were back in June of last year, this is all short covering? 9, 10, 11 months of it? Sorry, I'm not going to buy into that one. Short covering, yeah, I mean, we get a quick pop off of a big move down like we had back in March of 2022. We had a big move down, and then we went into option expiration week, had a big pop up. Yeah, that could be a short covering rally. Then we went right back down to new lows. This isn't anything like what we had in the first 5.5 months of 2022. We're not bouncing and then falling to new lows. Like I said, the 2 bottoms I called last year, we've had 5 trading days beneath those lows. And yet I'll do my videos and get posts from people who are on the bearish side, obviously not agreeing with me, and talk about what horrible calls I've made. And I'm just looking at it like, maybe you want to flip your monitor upside down, because since the June low and the September low, I'm seeing move to the upside. I've been long since June and my portfolio is going up. So call me wrong if you want, but I think the market action has spoken. Anyway, that's all I had for this particular segment, looking at best sectors and industry groups. So I'm just going to take like a 2-minute break here, and you are not going to want to miss these next 2 segments, the manipulation update and the sentiment update, because I think this is where really all of the really good stuff is in terms of calling markets and the manipulation that we've been through. And I feel bad for a lot of folks. On the one hand, I always think I want to put these kinds of events behind the paywall at Earnings Beats and only give it to members. But I also feel like from a community perspective and just knowing how many folks are being dragged by their nose by the media, I really want to give a different perspective so people can see what the heck is actually going on and what Wall Street is doing to everybody. I think there's I call it legalized thievery. But I got some really, really interesting charts. If you like any of this I've been going over, we're going to step it up on steroids in about 2 minutes. John, I'll let you take it away.
Wow. Okay. My hand's tired from taking notes. I'm telling you, folks, I've been taking notes myself, learning a lot. I do trading myself, so I rely a lot on what Tom provides. And this has been fantastic. Anyways, Tom's taking a 2-minute break just to keep his voice from crumbling. I do want to point out to you, we do this every session, that we've got a special. You can see up there the webinar special. And it's, if you like what you hear, you can take out a 30-day trial. It doesn't cost you a penny. And you'll be able to check us out. You also might be interested in the annual membership. So right now, the way we work is we have a monthly membership that's $147. We have an annual membership that's $997. So you cut your average cost down dramatically. And because you took the time to come into today's session, you can sign up for an annual membership and get 2 months bonus. So you get 14 months of membership. You end up saving 50% off the monthly rate. Now, if you're already a member, you can also take advantage of this, of course, and you'll get any time remaining on your membership. What's the significance of this? Significance of an annual membership is that really you get to see us in action for 4 full quarters. And we just I can't tell you how much we provide to our members, starting with Tom's daily market report, where he keeps everybody up to date on exactly what's happening in the market on a macro level. Every single day there are trading ideas, sector ideas. And then of course we have our webinars like this one, except some are for members only. I'll give an example that I'm going to wrap up here. Next Tuesday, we've got a Max Payne webinar where we talk about options expiration coming up next Friday and the most likely direction of the market over the next week or so. It's phenomenal what can happen during options expiration week. One of my favorite webinars. Every month we have that Max Payne webinar. Anyways, that's a member only one. We've got other member only events coming up, especially with earnings season upon us, that you'll like to see. So you can take out a trial membership to get access to this. If you want to save a lot of money, go with the annual, and we'll keep this, special open probably through the end of next week. But really get started now if you're not a member with a trial, and you'll have a full week before the membership, the annual special expires. And I think a lot of you are going to be sticking around with us for a year, hopefully to get Tom's guidance. This is great information today, but let's remember everything can change in a dime. So being up to date on the market on a regular basis is really important. Anyways, Tom, I'm going to go ahead and turn it over to you.
Okay, sounds good. Yeah, I mean, we try to give everyone an opportunity to kind of see us in action, and then decide. We honestly do not want you to be a member if we're not going to help you if we have different styles. But I think we offer so many varied products that I think whether you're a buy and hold, whether you're a short-term trader, I think you're going to get tremendous value out of our service. I know we have a lot of happy members. I've had so many emails that have come in, testimonials, talking about 2022 and what earnings beats has meant to them, getting them out of harm's way at the beginning of the year, getting them back in. I've had members say, listen, I would have never made those calls. I was like, and even when I was seeing them, I was like, wow, that's a bold call, but it turns out to be right. It's about making the calls based on risk management, not necessarily based on, today's the day, you got to get in or you got to get out. It's more about just going over all the things that we've talked about and just recognizing where risks lie and which side do you want to be on? Do you want to be on the side that is riskier, or do you want to be on the side that's less risky? When I go through this manipulation segment and go through the sentiment segment, if you're not blown away, and I know some of you members have already seen it or seen some of it, but if you're not blown away, I don't know what else to tell you, because what Wall Street does and the way that the market works, everybody thinks it's based on news. Oh my gosh, market needs to go up because of this news, or it needs to go down because of this news. And they train us that way, because if the market goes down one day, then you'll look and you see a news article and it says, S&P 500 drops on recession fears. And then the next day the market goes up and it's like, well, the market's rising because they're less fearful. And then the next day it's back to recession. They look to see what the market's doing, and then they just create a headline, usually the one that can drive the most clicks. And it's all just a bunch of garbage. You need to be able to see the big picture. You need to have perspective. You have to have patience. And honestly, I think some coaching along the way is not a bad thing. When we get folks that write in and say, hey, Tom, I want to thank you for that chart that you put in on NVIDIA the other day. I bought that stock and I made $1,000. Man, you're great. And you know what I think when I read that testimonial? I think, well, I'm glad that stock went the right way, because if it went the other way, they probably wouldn't be a member today. So the testimonials that I like are the ones where someone says, wow, I cannot believe the way the stock market operates. I didn't know any of this stuff. You've given me so much education. And now I feel more confident when I'm approaching the stock market. I actually can sleep at night because I know that you're kind of watching the market for me. And those are the testimonials for me that really get me going. It's not about, oh, this was a great trade, because if you've been in trading, you're going to have wins, you're going to have losses. There's no way. I love some of these services that come out and say, we've hit 155 trades in a row. I'm like, okay, first of all, I don't like to call anybody a liar, but to me, that has got to be a lie. I mean, maybe what they're saying is that every time they've put a trade out, that it's traded at least 1 penny higher than when they put it out. And so therefore they can claim that it was, at least at one point, it was a winner. I mean, maybe you go with that, but anybody who trades knows, and I wouldn't even look at somebody who gave me those kinds of results. I mean, that's not even reasonable. But anyway, I'm going to jump back in here now because I want to get into this manipulation. And first, I want to start off with some stats that you may not be aware of. So I'm going to start off first. This is a 75-year chart on the S&P 500 going back just before 1950. So since 1950, I have every single day of the S&P 500 in an Excel spreadsheet. Being the CPA and being somebody who just loves to analyze. I mean, when I was in public accounting, I used to love to analyze individual companies. I would go into a printer and I would be like, okay, what if you, instead of having 2 shifts of 8-hour shifts and closing, what if we did 2 12-hour shifts? You paid overtime. I mean, any kind of an analysis like that, I would really just get into. I loved trying to try to help businesses and find out what makes them tick and how can we better the profits. That was what I did in public accounting. I loved it. And so when I started getting so passionate about the stock market, and actually this passion goes back into the 80s. I was in public accounting until the late 1990s, maybe even early 2000s on my own for a little bit. But I was passionate about stock market the whole time. And I read John Murphy's book, Technical Analysis of Financial Markets. And that was what just spurred me on. Lights started going on in my head. And I started thinking, wow, watching the intermarket relationships that he was teaching, I was like, wow, there's got to be so many things that I could learn about the stock market, I could analyze. And so one of the things I did was in public accounting, when I would go out and audit companies, they would have payrolls that usually ran either the end of the month or maybe every 2 weeks, like end of the month, middle of the month. A couple of clients would have every weekly payroll, but for the most part, it was like 1st and 15th kind of a thing. And occasionally like there'd be once a month. Anyhow, if you think about that, and you think about the 401k withholdings that come out of all the employers' payrolls from around the world that turn around every 2 weeks and go into the stock market, they're sent to Fidelity or Vanguard or whoever the plan sponsor is. And when they get the money, Fidelity doesn't get the money and say, well, let's wait until the PPO turns up before I put their money to work. They have the fiduciary responsibility that when they get that money, they put it to work. And however you tell them, if you say, hey, put it in 60% growth, put it in this fund, 30% in this fund, 10% in that fund, that's what they do. They take your money and they invest it. And so I always wondered, what impact does that have on the stock market? And so I put every day's trading action on the S&P 500 into an Excel spreadsheet, and I started analyzing the data. Now, since 1950, the average annual return of the S&P 500 is about 9%. I think it's 9.1%. So if you just bought back in 1950 and you just held, your account on average would have gone up 9.1% on average. Obviously, there are ups and downs. And so I started looking at the days of the month, thinking, what impact does the money come in? Like if payroll is the 1st of the month and the 16th of the month, or the 31st and the 15th, that money coming in, wouldn't that drive the stock market higher? I mean, those were questions I was asking myself many, many years ago. And so being the neurotic Excel spreadsheet person that I am, I started looking at this. And so these are the results. So from the 26th of one calendar month to the 6th of the next calendar month, the S&P 500 has an average or has an annualized return of 21.01%. Now, you might think, well, why the 26th if the money doesn't come into the first? Okay, well, do you think I'm the first one that's ever thought about money coming in? Do you think Wall Street's not aware that money comes in? Think portfolio managers aren't buying ahead of that money coming in? So I look at it as though smart money is buying at the end of the month because money from us, you and me, through retirement accounts is going to come in around the end of the month or early in the beginning of the next month. So you have anticipation, what I call legalized front running, because the market makers have been caught and been in trouble because they get an order and then they put their order in first and then they give you your order. That's called front running, and that's illegal. But this isn't illegal. You're buying multiple days ahead of time because you know the money's coming in. I call it legalized front running. So this period is more than twice as bullish. You would think if the S&P 500 goes up 9.1% on average per year, that every day of the month, if everything were equal, we would see 9.10%. I should be looking at plus 9.1% for all of these different periods of the month. But you can see the numbers are quite a bit different. 26th to the 6th, very bullish. 7th to the 10th, down. You might look at it and say, well, yeah, but it's just 4 days. That sample size isn't very large. It's 4 days of every month, 12 months a year for 73 years. It's a lot of trading days, trust me. Minus 4.09%. That is 13 percentage points below what we should expect. Why? Well, after the money stops coming in, profit taking. You know, I mean, you get money coming in, builds prices. You got traders jumping on because prices are rising. And then Wall Street pulls the rug out from under them. Market makers start selling. Create a little bit of an opposite rotation in stocks. Then the 11th to the 18th is just a repeat of this one. Remember, second payrolls could be around the middle of the month. Not all. So I don't think you get the same amount of money coming in that time as you do at the end of the month. But still, better than the 9.10%. Now we're 12.33% from the 11th to the 18th. And then the 19th to the 25th. This is one of my favorite periods. Minus 7.59%. That is more than 16 percentage points below the norm for those 7 days in the calendar month. Why in the heck does that happen? Well, when do monthly options expire? Remember, when options are bought, many times market makers are on the other side because the options are not as liquid as a stock. Most of the time when a stock's bought, you have a willing buyer and seller, individual. When you start talking about options, somebody wants to buy 10 contracts of maybe, Apple, maybe you have somebody on the other side, but there's a lot of other companies that you can buy 10 contracts for, and they may not be heavily traded, or at least not where they have somebody, to that extent. So you've got market makers stepping in on the other side of these trades. When the market tends to go up from the 11th to the 18th, that means most of the in the money calls, or most of the calls are going to be in the money, and many of the puts will be out of the money. And so most months, it would behoove market makers to begin selling stocks, the underlying stocks, and trying to drive the prices down. Why? Because those call options that earlier in the month have a lot of value, come option expiration Friday or even into the early part of the next week. I talk about that, why it would go into next week. I do that. I always talk about that at our Max Payne webinars, which again, if you take out that 30-day trial, you'll be in, or if you sign up for the annual membership, you'll come in next Tuesday night to our monthly Max Payne webinar. But the leading up to option expiration and then a few days following option expiration is when the market tends to sell off. And I think a lot of it has to do with market makers because they have a ton of call premium, or sometimes put premium, net put premium, but usually net call premium at stake. And it's a short-term phenomenon because the options expire, right? So they only have to just pull the stocks back for a couple of days. When we're not seeing any new money, or relatively little new money, it's easier to control the action. You bring prices down just temporarily, and you save millions and millions, sometimes billions of dollars over time because of this market maker manipulation that takes place from the 19th to the 25th. And then as soon as you get past option expiration, rinse and repeat going into the next month. Now, does this mean that every month, the 26th to the 6th, you're going to go higher? No. Please don't misunderstand what I'm saying. This is a long-term historical tendency. It's just, again, it puts the bears more at risk. And you want to be long because we know history is on our side. So if I know nothing else about what's going on in the market, I would tend to want to be bullish because of this statistical fact. And then the other periods, as I said. The other thing I want to just point out, quarterly trading since 1950. You might not realize this either, but the stock market tends to be a buy on rumor, sell on news kind of thing. You've probably heard that. That's a Wall Street adage that I like to follow because I believe wholeheartedly in this one. Buy on rumor, sell on news. You see a lot of companies come out with great run-ups prior to earnings, and then they come out with great earnings and they gap up and people jump in and then they flop for a period of time. It's because the valuation, all that move to the upside's already occurred. Look at January 1st to February 15th. Now think earnings season begins usually around the middle of January, and most companies have reported by the middle of February. There's still a bunch that report later, but I'm talking about the overwhelming majority of big companies have reported by the middle of the second month of a calendar. So January 1st to February 15th, buy on rumor, plus 12.49%. Again, above that 9.10%, right? February to March, the second half of the quarter, only rises 4.8%. Look at April to May. This is the period we're in right now. Rises 13.25% annualized. May 16th to June 30th, 1.15%. July 1st to August 15th, 10%. And by the way, a lot of this right in here is after May, right? Remember go away in May? Yeah, I don't think so. Beginning of May typically is very strong. And you can see July to August is another 10%. Most of that is, again, early part of July tends to be pretty strong. Then you go into August 16th, September 30th. That's the second half of the third quarter, minus 4.88%. And then you get into the fourth quarter, which says, we're just going to go up all quarter. I've told members, I've told everybody, the best time in the stock market, historically, October 27th close to January 18th close. That historically has been the best time to be in the market. Another interesting fact is we've had 14 bear markets. If we count October of last year as being the bottom of the 14th bear market, that we've had 14 bear markets. 7 of them have ended in October. 7 have ended in October. Half of them. You would think normal dispersion, you got 12 calendar months, 14 bear markets, probably you'd think they'd be spread throughout the year. Half of them are in October. And followed up by the fourth quarter, where the first half and the second half both generate returns over 16%, better than any of the other quarters, both halves. The 2 best halves of any quarter, they both come in the fourth quarter. So if you're really bearish going into the fourth quarter, just be ready for a bottom to print. And it did. October 13th, it printed. And I think that's going to turn out to be our final. So this is the first kind of wave of manipulation that I want to tell you about. It's just knowing when the money comes in. If you're a trader, this information is gold, because it's just giving you better odds. It's not going to give you a guarantee. If you say, hey, I'm going to jump into everything on Monday morning because Tom said we're in this April 1st to May 15th period and we go up, 13.25%. That is not what Tom said. Tom's not saying we're going up 13.25%. He's saying that the days project to an annualized return of 13.25%. Over 45 days, I don't know, that's what, probably about 12, 13% of the total days of the year. So take 12 or 13% of that. Maybe it's 1.5% that the S&P 500 actually averages going up during this period, 1.5%. So if we're at 4,100, that's 60 points. Okay. So don't go into this thinking that over these 45 days, Tom's saying we're going to go up 13%. That is not what I'm saying. You got to understand a little bit about how math works, the annualized returns. But once we get to May 16th, then we don't see as much gain. Okay. Historically. All right. So that's point number one. Let's take a look. I want to show you one indicator that probably 3 or 4 years ago, I didn't even have on my charts. And I have grown to love this indicator, especially because it turned me on to figuring out all the manipulation that was taking place in 2022 and so far in 2023. The AD line, accumulation distribution line. Two things you need to know about the AD line. The first thing is that we have, or that this indicator ignores gaps. It does not take into account overnight gaps. So if the S&P 500 or the spider one day was trading at 110 and the next day it opens at 106, AD line does not treat that as distribution. It only looks at what happens during the trading day. Now, I want you to think about this. This is somewhat common sense, but you may not think about it this way. Let's say that there are multiple portfolio managers and some of these institutional investors that foresee a bear market coming. Let's say they've got their money with Goldman Sachs, and Goldman Sachs says, you know what? It's December 2021. We're moving our money into safety. We see problems ahead. We want to sell, some of the stocks. We want to lower your exposure. When they sell, they are selling throughout the trading day for a long period of time. If they have an institutional client that wants to sell 500,000 shares of Apple, market makers don't go in and put a market order in at the opening bell. If you watch the opening bell, if you do watch it, you would know that it is the most illiquid time of the trading day. And what I mean by that, first of all, is volume, it picks up in the morning, but when you first open, I'm talking about the first minute or two, some stocks are pretty slow to open. They don't all open right at 9:30. Some might open in 30, 45 seconds, a minute later. And the other thing is the bid and the ask, the spread is really wide at the open. And then once we start to get more volume and things start to settle down, 5, 10, 15 minutes later, you'll see the bid ask come back together again. You would not put your institutional clients in at market when there's there's little volume and wide spreads. So institutions, big money is not getting in or out at the opening bell. Now, maybe if they're getting in, maybe some of the accumulation is taking place based on the gap down. And maybe when you're getting out, maybe some of the distribution takes place when folks are bidding it up at the, getting open gaps to the upside. I'm going to talk a little bit more about gaps in a little while. And I think you're going to find it fascinating. But the AD line completely ignores it. So what it really is telling you, the AD line is calculated based on the volume of that day being the multiplier. And essentially, where do you close that day relative to your trading range for the day? So if, let's say, you gap down on the spider, let's say you were here at 115 or whatever that number is. And let's say you gap down to 110 at the open. And then by the close, you've worked your way all the way back up and you've closed at 115 and you finished that. That was your high of the day and you finished right on the high of the day. Now, you will look at it and you say, well, the spider went nowhere. If you look at your count at the end of the day, you'll say, well, yesterday I was at 115. Today I'm at 115. No change. It was a ho-hum day. AD line says otherwise. The AD line says, yeah, we opened at 110, but there was buying all day long, finished right on the high. So 100% of that volume is going to get added to the AD line, even though the spider went nowhere that day from the prior day's close. And the flip side would be, okay, you gap up. And it doesn't matter whether you gap up or you gap down, but you sell all day long and finish at the low of the day, you would subtract 100% of the volume. And so all the AD line is just this cumulative reading of volume being added, subtracted, added, and subtracted. If you finish right in the middle of the trading range, there'll be no change to the AD line because you're right in the middle. There was no real sign of accumulation or distribution. You had this trading range from say 110 to 115, and you closed at 112.50, right in the middle of it. Was there accumulation during the day or distribution? I don't know. It's right in the middle. So AD line doesn't get impacted. So that's, so if it's a little bit above the midpoint, then it would go up slightly. It would be a lower percentage of the volume would be added. If you're a little below that midpoint, a little bit of the volume would be subtracted. That's all the AD line does. It's a very, very simple indicator. Look in 2007 to 2009 during this 59% decline and look at the AD line. From October of 2007 at the high to this bottom here and then this other bottom, I think it's pretty clear that the AD line went down. I mean, how much? I mean, there's no numbers over here. It's just a cumulative reading, just goes up and down. So this isn't really a factor. All you're interested in, or all I'm interested in, is it going up or is it going down? If it's going down, it's telling me there's distribution taking place, right? In July of 2009, the AD line broke to a new high. Look at where we were in July, still way below the prior price highs. This was an indication that we were starting to see massive accumulation in the spider as we were going down and then on the way back up. Now, I want you to look at these pullbacks. This one right here in 2010, not even a glitch on the AD line, just kept going higher. Here, yeah, we pulled back a little bit, but right here, when we had this little bit of a move back up, we were still down, right? AD line broke to a new high. It was foreshadowing move back to the upside, continuing move to the upside. Look at 2015, 2016. This was kind of a weird period, and I didn't even use the AD line back then. Had I probably would have been much, much more bullish at the beginning of 2016. But here on these lows, notice the AD line is just going up higher and higher. Wall Street's using all that volatility to just build positions. So imagine they're just sitting there, just waiting for everybody to come through the turnstile. Thank you for selling. Thank you for selling. Thank you for selling. I'll gladly buy all of your shares. And then the market goes higher. 2018, trade war. I mean, we went down just a little bit, but before we got out here to new highs, the AD line was already setting new highs. Look at the pandemic. This one was when the manipulation really started to, I mean, I've really jumped on the manipulation bandwagon here because what was happening at first is we saw a little bit of distribution, people selling during the day, and then Wall Street, in my opinion, you were seeing the worst headlines about the pandemic. Everybody was going to die. If they didn't, they were going to have an uncontrollable lung infection and they were going to be disabled. I mean, the news was horrible. And listen, I know that the healthcare crisis was real, and I'm not trying to diminish that at all. Folks had a lot of problems with it. And I think a lot of the steps that were taken were probably very necessary. So I'm not getting into any of that. I'm not saying it wasn't a bad thing, from a health perspective. What I am saying is that look at the AD line. Do you even see a blip on it? I mean, look at all this back here. Clearly, everybody was getting out. There was a lot of distribution. Many days we were finishing on the lows. Here, AD line, it looked like all the other periods. If you looked at this AD line, would you have thought that there was a 35% drop in the S&P 500? Of course not. And I said then, and I wrote about it then, it was a healthcare crisis. I remember I wrote it. Some things I don't forget because I'm a numbers-oriented nerd. March 13th, I wrote an article at Stock Charts. You can go find it. March 13th, 2020. Go look in the archives. But I wrote an article and I said, this is not going to be a secular bear market. This is going to result, we're going to go right back up to all-time highs, right in the middle of this, when everyone was saying Great Depression 2.0. And a lot of it was just the manipulation. We were seeing gap down after gap down, and then selling early in the day, and then we'd come roaring back late in the day. Miracle. Then we had one of the greatest runs to the upside, and the AD line followed it all the way up. But look at 2022 and 2023. Looks a lot like this back here, right? So I can understand why when you look at the price action, you might say, well, we got the big drop coming. We haven't even seen the big drop yet. We got the big one coming. But there was a lot of distribution taking ahead of that drop. Wall Street was getting out. It had already gotten out to some degree, but was really getting out during 2008. That was distribution. And you can see it clearly there. Can you see it clearly here? We're at an all-time high right now. The AD line is treating this whole bear market pretty much like it treated the 2020 pandemic, with a big yawn. This double bottom right here with a big yawn. There are many willing buyers. And the problem is we're running out of sellers. Everybody's so bearish. For the most part, everybody is sold. So anyway, I think this is what spurred me on to do more work on the manipulation. When I started seeing the AD line and how it worked, and I give credit to Mark Chaikin on this one from Chaikin Analytics. This was a pretty ingenious indicator that he created. And maybe there are ways to tweak it and make it even better. I've been thinking about that, but I really like it. I have the AD on most of my charts now. I like to follow the AD line, and I don't use this as my primary indicator. I don't look and say, oh, AD line's going up, I'm going to buy the stock. I still look technically to see why I want to buy the stock based on the price action. But if I have a strong AD line, it confirms it for me. It's giving me further evidence of that trade. All right, now I'm going to show you some other AD lines. I'll go through these very quickly. Here's the QQQ. You can see, again, very choppy. Look at the rest of this action. Sitting at an all-time high right now. How about the XLK, technology? You can see we struggled a little bit here, rolled over, and then quickly went back to new highs. And you can see we've had some choppy a little along the way. No choppy in 2022 and 2023, though. We just keep moving higher, meaning that there are plenty of willing buyers in the afternoon. How about the XLY? XLY, pretty choppy, 2007 to 2009, but ultimately went higher. For the most part, end of 2018, we saw a little movement to the downside. Maybe initial March, very, very quickly to the downside, but otherwise, new high. All the key areas of the market are setting new highs on their AD lines. So you got to kind of think about that. And actually, there was one other. I'm going to get into this chart in just a second, but I wanted to also, there was another article I wrote. This was back in July of 2022, end of July. And I wrote, we're heading for new all-time highs. And I talked about one thing I wanted to show you. This was the history of the cyclical bear markets. So this only includes, this doesn't include 2000 to 2002, 2007 to 2009, and back in the mid-1970s, 73 and 74. It doesn't include those because I'm just looking at the cyclical bear markets. And this was done assuming at the time that the June low was the low. And as we now know, we have a lower low in October that went just a little bit. We got down to 34.91. So I think this minus 24.5% now is down around 27, 28%, I believe. I think it's 27 and change. Now, if you look at the averages of all the cyclical bear markets, the one that we just had, even if you go down to the October low, has finished right about the average cyclical bear market. That's about what we get. And we also average about 6.5 months. Well, we went a little over 9 months. So the one that, this one had gone just a little bit longer. Some are long. The one in 1980 through 82 was the longest, 68 to 70. That was kind of like transitioning into the secular bear market in the late 60s and out of that secular bear market in the early 1980s. So I think there's probably a lot of, money transferring back and forth for an extended period of time. But if you look at the other ones, you can have some really short ones like with the pandemic. You could also have some that are 2 or 3 months. Here was the trade war, 2018, fourth quarter, 96 calendar days. So these are just the calendar days. So the one that we were in, which went through June 17, that would be another 90 days. So this would probably be about 260 days, I'm guessing. Maybe, no, probably more than that. Maybe 270 calendar days. Maybe I'm going to say, let's go 280. So it's a little bit longer than normal, but kind of still in the ballpark of what we would normally see. But the thing I wanted everybody to realize back then, because a lot of people are like, why do you call a bottom? Why not just wait until the market goes up and not take that risk of it going lower? Well, because all my signals, number one, are telling me that the risks are actually, I'm going to miss the move to the upside. So why do I want to wait and miss 20% upside or more to get the confirmation of what my signals are already telling me? So I pointed out what happens 6 months, 1 year, 5 years, and 10 years after a cyclical bear market ends. Look at the 6-month returns. Anywhere from 10% to 48%. The average is 29% in the 6 months from a bottom. That's 6 months from October 14th is what? April 14th. We just had it. It was Friday. So the 6-month anniversary on this one is now in, assuming, if I change this date now to 10/14 that we hit, I think the low intraday. We went down to 34.91. So we now know that percentage is 27 point something. And the S&P's return, I think, is 15 or 16% now off the low. I think I showed that earlier. So it's not as much as some of these, but it's still been a nice return. And keep in mind that the one that was the least amount 6 months later, look at what happened the next 6 months. It went up another 22%, which if you look at all of these others from the first 6 months to the second 6 months, that one beat all the other ones, except coming out of the pandemic. That's where we really just took off and kept going. But that 22% the second 6 months, maybe, and I think possibly that's what we're going to see again. I think we're still waiting. I'm going to show you something with sentiment a little bit later, but once that hits, I think the market is really going to be poised to go to the upside. But anyway, I think it's pretty interesting. And so this is why I try to call bottoms and why I try to call tops. I think it's elementary. I'm trying to make as much money as I can until I retire. I want my money to grow. So if I can call tops and bottoms, I'm going to do a lot better than everyone else who just keeps riding it. When you ride the stock market from 4,800 down to 3,400, you don't get back into the green again until you get back up over 4,800. You don't get back to your all-time high until later. What if you get out at 4,800 or even 4,600 and you were able to get back in at 3,600? By the time you get to 4,800, you're 33% past your all-time high before. The numbers are astounding. Actually, I ran a number and I said, what if you had a 500,000, let's say you're 55 years old. You got to retire in 6 or 10 years. You're going to retire at 65 and you got $500,000 stashed away. Let's say you just decided you were going to ride this out from 48.18. So, going to June 17th, let's say you did this on June or at the beginning of 2022. On June 17th, you'd have been down 25%, right? Essentially 25%. So your 500,000 would have gone down to 375. Now, if you were, okay, things look a little strange, I'm going to move my money to cash. I don't want to take a chance here in 2022. You avoided that 25% drop and your 500,000 is still sitting at 500,000 on June 17th. And let's say from that point forward, you earned 12% over the next 10 years, which in a secular bull market, 12% is a reasonable amount. Remember, the S&P's gone up 9% every year since 1950. That includes all those bear market years. So if we're truly going to be in a nice period for the next 10 years, potentially I could make 12%. So that 375,000, forget about making any additional contributions. That 375, 10 years later would be worth 1,164,000. The 500,000 would be worth 1,553,000. So the 125,000 savings now will grow compounded over the next 10 years. That makes a $400,000 difference in your retirement 10 years from now. Do you understand why I would want to spend all the research that I do to try to find for our members the reasons why you want to get in or why you want to get out, and when the risk? When I talked about this at the beginning of 2022, listen, I didn't come across and say, I guarantee you the stock market's going down 25%. I can't do that. I don't know that. Market could go higher. What I said at the time was the risks of being long are not worth the potential reward. Not after you just had 115% rise in the S&P 500 over 22 months. That's crazy. People without perspective think the market's just going to keep going up. Folks, the market goes up because our GDP goes up. The market goes up because of inflation, 2-3% on average. And the market goes up because of innovation. Companies like Apple and Amazon, because of what they do, that's why the market valuations keep going higher and higher. It's because of those really good large cap companies that are so innovative and continue to produce jobs to grow the economy. So 9 or 10%, if you're just getting into the spider, if you got into the Apple, you probably would have retired when you were 45. Wouldn't have to worry about it at 55, what you're going to be at 65. But putting all your money in one company, I hope you get the right company, because most companies are not Apple. Most companies don't go up like that. So the safer way is to say, okay, give me the S&P 500. Give me 500 of the largest companies in the world. That's a diversified way to play the market. And that diversified way yields 9% for 72 years. So again, 9% versus 12%. That's doable. And the QQQ, by the way, I would expect if the S&P does 12%, I think QQQ will probably do 18%, 16 to 18%. I wouldn't be surprised on average. So I'm personally a little bit more of a risk taker. I'm sure many of you are not. But there's still ways, just stick with the S&P. Or if you do, 60-40 allocation normally, stocks to bonds, maybe, I don't know, maybe you lower the stocks when the market looks like it's topping and when the market looks like it's bottoming. Maybe you go 70-30, 65-35. I don't know. It's up to each individual. I always tell folks, I think we're somewhat aggressive, mildly aggressive, maybe sometimes a little bit more than that. So when I look at what we offer at Earnings Beats, I think you should be looking at your portfolio. And let's say you do have 500,000 in a portfolio, or maybe across multiple portfolios, taxable and non-taxable. And you say, listen, I'm going to be really aggressive with 20% of my money, 100,000. I would probably use that 100,000 and follow Earnings Beats. And I think you'll outperform over time. I wouldn't encourage you just to say, hey, Tom Bowley says this, let me just put 500,000. Let me put my whole life savings into this. Probably not the smartest move to do with anybody. But again, I'm talking about the spider. I'm talking about the QQQ. I'm talking about those kinds of things. So anyway, I just wanted to show you what happens when you come out of bear markets. You need to be in during those first 6 months. We've been already 6 months, in my opinion, from the bottom. And if you've been in the market, you've made a pretty nice return. If you've been out of the market, you're just watching potential return go away. And if you're shorting the market still, I don't know how you're surviving. I mean, maybe you're catching the down moves and you're getting back out when the market goes up. Maybe you're timing it perfect and you're going up and down, long and short, and you're nailing everything. Congratulations. I mean, that is spectacular. And if you can do that, don't change a thing. But most traders, I'd say, probably aren't doing that. They're probably very bearish because that's what everybody's telling them to be. And they're not paying attention to all these other signals. All right. So let's go on. I want to show you, this is probably my favorite chart. I mean, this really blew my mind when I started going through it. And before, essentially, well, let me explain a little bit about what it is first, and then I'll bring up an Excel spreadsheet that I want to show you the type of stuff that we do at Earnings Beats that nobody else does. Anyway, topping phase right here. What I was pointing out, this, remember that was the December move to the upside. Remember the S&P 500. This is the QQQ. But remember the S&P 500 actually made a high right at the beginning of 2022. That was the ultimate high. Well, during this period, I looked at the QQQ because it is a little bit more volatile, just to see what was going on. During this period, the opening gaps for this entire period, if you net them all together, every single day, you look at where we were yesterday's close, today's open, and you netted them all together from November 21st to the end of December, the opening gaps were plus 630. Market was gapping higher. From 9:30 to 10 a.m., the net from 9:30 to 10 a.m. every day, you went up $4. 10 to 11 a.m., you went down $19. And 11 to 4 p.m., you actually went back up $8. So you saw gap ups, you saw a little bit of morning strength. Then the rest of the day was a little bit of selling, although there was some buying in the final 5 hours. But that net was you open stronger, you trade up in the very early, and then you sell off over the course of the balance of the day. That was taking place as the market was moving up. So I think maybe we were getting some opening gaps to kind of create some more buyers. How do you think, Mark? How do you think Wall Street gets out if they want to start getting out of positions? They've got to be, people have to be led that way. And I think there's a lot of manipulation that takes place based on the news, based on these opening gaps. When you see the market open up, don't you feel better about stocks? And when they open down, don't you feel worse? I mean, when they open up, it's like, oh man, I want to get in. And when they open down, you're like, oh, we're going to drop. I got to get out of my portfolio. We're always trying to follow whatever the market, the market masses follow everyone else. That's why they are the market masses. That's why sentiment works, because everybody gets on the same side of a trade. And usually when they're getting on late, it's a big, big mistake. So in this case, we saw a little bit of in this topping phase of money rotating away during the day. I mean, if we just ignore the gaps, we went down here a little bit, but we gapped up $6. So if we just net the rest of the day, we went down, I don't know, $7 the rest of the day on the QQQ. Now, during what I call the distribution phase, and this is where we really had a bear market. This is where I said, be careful. And actually right in here at June is where I said, it's time to get in. But from January through May, look at the gap downs, minus $30, 9:30 to 10 a.m., minus $35, 10 to 11, minus $32, 11 to 2, minus $31. And it was only during the 2 to 4 p.m. time period where the QQQs had any success during the first almost 5 months of the year. So from here, 400, we were clear near 400, and we went all the way back down to, I don't know, somewhere around 285. So we were down $115 on the QQQ. And this is the dispersion of how we lost it throughout the trading day. But just notice, down, 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 finally up a little. Look at the manipulation phase, bullish manipulation phase. This is when the media and actually sentiment started getting more and more and more bearish. The headlines are getting more bearish. Now we're starting to get the bearish news. The Fed's starting to hike rates more aggressively. Don't fight the Fed. My gosh. We got September and October coming up. Market's going to crash. We got all that talk. I want you to look during this phase, what happened. Opening gaps down 44. Well, first, where did we go from? 285 down to 262. We lost $23 on the QQQ. But at the opening bell, we lost $45. And by 10 a.m. from 9:30 to 10, we lost another $33. Combined, we lost $77 from the close to 10 a.m. the next morning. But wait a minute. How could we lose $77 on the QQQ in just the first 30 minutes of trading when we only went down 22 for the whole period? Well, thank your friends on Wall Street. I can tell you individual traders weren't buying. They were so scared. Put call ratio was going through the roof. I'm going to talk about the equity only put call ratio in just a little bit when we do sentiment. Look at the recovery. $52 or $51 worth of recovery. 77 going down. Maybe I might have a couple of dollars off because that's 285 to, maybe it's a little bit lower than that. Maybe it was 261, 261. Yeah, maybe it was $24, $25. But my point is the selling was all at the opening bell and in the first 30 minutes of trading. I call it amateur hour. It's because the news is so bad. The headlines are so bad. Market makers create the gaps to the downside, and then folks panic and sell. And once again, Wall Street is waiting for you with open arms. Thank you so much for selling. Thank you so much for selling. Please come again. Buying stocks the rest of the day. Why are they buying in the afternoon when the market's going down? I can tell you why. First of all, Wall Street doesn't just push a button to buy and be fully into positions. It takes a long time. We're talking about big institutional investors. They're not buying 100 shares. You and I, we could go from being fully short to being fully long in probably about a minute or less, just clicking on a few buttons. You can't just do that with millions and millions of shares. Market makers accumulate to go long for their institutional clients. How do they do that? By taking advantage of you and me. They need that fear. They need those gap downs. They need those amateurs in the morning selling so that they can buy at lower prices. That's one of their responsibilities. That's in their business plan, to buy at the best price possible for their institutional clients. In addition to providing liquidity in the markets, that's what they do. So now we're into the accumulation phase. Now we're moving up. Look at the gap down, minus 11. Still got people that are scared, market makers taking advantage of it. But look at the amateur hour now. Even amateur hour is starting to turn green. We're starting to see buying of the Qs from 9:30 all the way to 4 o'clock. It's really just the opening gap. Look at, we went from what, 261 to 318. So what is that? $57. We went down 11 opening gaps. That means we went up 68 during the day, up $19 from 9:30 to 10, down $3 from 10 to 11 on a net basis, 11 to 2 up $32, 2 to 4 up $19. Look at how everything has changed. Started off over here, opening gaps, selling. Opening gaps lower, selling. Opening gaps lower, a lot of selling, little bit of buying late in the day. Opening gaps lower, a lot of selling morning, starting to buy, pretty significant buying late in the day, to now we're in a phase where we're just gapping down and we're just buying. I've actually been buying some stocks. I've changed a little bit of a strategy where I'm just looking at stocks, good stocks that have really nice, strong AD lines, maybe have good scooters in positive sectors and industry groups. I look at them when they go down in the morning and I buy them. Why? Because the AD line, everything is being accumulated. So it's a completely different strategy now than I would have never back in here been buying stocks. I mean, I basically told members I wasn't going to buy individual stocks unless maybe with options expiration, take a little position, because short term, there was a lot of in the money puts. So it actually was good for market makers to go back to the upside for options expiration. So for a period of time, it was actually the market makers were buying into option expiration week. But I mean, just check that out. If that's not just textbook manipulation, I don't know what is. I don't know how you can look at that and just say, well, it's just random. That doesn't make any sense. I mean, if that's what you think, that's fine. I think it means a lot. Again, I've studied the market for a long time. I love Excel. I'm going to show you my Excel spreadsheet for a minute. So hold on. Let me show you this spreadsheet. This will show you exactly how ridiculous I am and why I don't go to New Year's Eve parties. All right. So this is the data for the QQQ. Now, I go all the way back on this particular one back to the beginning of 2021, but I'll just start here because this is where we kind of got started on the chart. This is November 22nd, 2021. This is the opening price, 10 a.m. price, 11 a.m. price, 2 p.m. price, and the 4 p.m. price. This is the change between the prior day close and the current day open. So there's your gap. There's the difference between 10 a.m. and the open. So that gives you your amateur hour. This is the difference between 10 and 11 and so on. So I've got every day broken down. I'm not making any of this up. This is a spreadsheet that I do, and I have some audit controls on here to make sure I'm getting all the numbers right. I'm pretty sure these numbers are very, very accurate, perfectly accurate, I would say. Anyhow, I do this all the way, and I've broken it down into some of these different periods. So here, for instance, the market went from 400 down to 340. We were in a downtrend. So I was kind of watching to see how we were trading. Was there any accumulation taking place? Look at the final 2 hours there, down $28. That was when the bear market was first getting started. Everybody was selling, including the including Wall Street. Everybody was getting out. They were just selling all day long. And then we'd have some rallies. So here we went from 317 to 370 during that late March rally. How did we do? Well, we were going up all day long. Of course we were. Market makers needed it to go higher. So they were probably buying throughout the day. And then you had other traders jumping on board and so forth. Then we go into this long tailspin, March 30th, 366, all the way down to 288 and so forth. Anyway, I do this for all these different periods. I come down all the way to 2023. There we are. I've already got the update from yesterday. And this is taking the November 21st close on the QQQ to the April 14th. It's down minus 81.95. Then I take all of these intraday, add them all together, total amount here to the side, add them together. Look at the number, 81.95, 81.95. And then I start doing a little bit more analysis, putting the periods here and showing the green versus the red. And you can see a lot more red early in the day over here through 11 a.m. And then you start seeing a lot more green over here throughout the period. And then I come down to these totals. So since November 21st of 2021, the QQQ has gapped down $80 net. And it's gone down $44 in the first half hour. It's gone down $46 in the next hour through 11 o'clock. So it's actually gone down 80, 122, $168, maybe 169. But look at the rest of the day. From 11 to 2, we saw some buying, but look at all the buying that takes place in the afternoon. $83 going higher. That's crazy. That's how those AD lines are rising, because we're seeing afternoon buying. Wall Street is letting everyone sell. We started off with some gap downs, some additional selling, and then Wall Street comes in and says, okay, you've been selling great. That's awesome. Thank you so much. Now I can get all these prices or get all these stocks so much cheaper. Awesome. But I mean, I've done this for the QQQ, for the spider, for the QQQ relative to the spider, the XLK, the XLY, the XLP, the XLY versus the XLP, all of this intraday data going back since the beginning of this manipulative period. All of it on Excel, and it was manual posting. Took a lot of time, but it also gave me a lot of valuable information that has saved me a bunch of money. I think it saved a bunch of members money, and I'm making money. I mean, I've been making money. I made money in 2022, making money in 2023. You don't have to lose money by listening to all the news stories out there. You just got to be able to do your research or follow our research and do some independent thinking. And then I just did some other stuff where I was just kind of messing around. I'm not going to get into all that. We'll be here all day. But that just gives you a sense of when I do research, I dig in. I dig my heels in. And I've got others at Earnings Beats that are helping me do some of this research so that we can provide the best information anywhere to our members. Don't listen to Wall Street. Well, listen to Wall Street. Don't listen to the media. All right, let's get back out of here. And I'll go back to my charts. And we shouldn't be a whole lot longer. I do want to get through sentiment, which will take a little bit of time. But we're getting close. And I know we're already past the 2-hour mark. I was kind of hoping to be done within 2 hours. But most of you are still in the room, so I guess I'm keeping your attention. Let's go on to, here's the QQQ versus the SPY. So this is correlation at the bottom. So here's the QQQ relative to the spider for the last 20 years. And you can see it pretty much goes up, went up too far in 20 and 21, and then we pulled back. Now we're starting to go up again, but I think we're still perfectly intact on this uptrend, long-term uptrend. Down here is the correlation. How accurately does the QQQ relative to the spider, how accurately does it also move in lockstep with the S&P 500? That's what this down here tells us. Most of the time, it's above zero. This horizontal dotted line going across here is the zero line. So the more time you spend above zero, the more this ratio is positively correlated. Time below, the more it's negatively or inversely correlated. They move opposite one another. You can see that generally, it's not perfect, certainly not perfect by any stretch, but I would certainly say that we spend a lot more time in positive correlation territory than negative. That's why I like to follow this ratio, because it is a pretty decent follower or leader, depending on how you look at it, of the S&P 500. So I love what's going on in 2023 as this is starting to move up. And you can see the S&P is going up and we're getting positive correlation. The next up is the QQQ versus the spider. 10-year treasury yield goes down, QQQ rallies. Inflation soars. That's not good for growth stocks. QQQ goes down. Then we had one final run before we had our bear market. Warning sign, that's December 2021. Remember, S&P went up, this went down. Then growth gets crushed during the bear market. And that's normally what happens, because bear markets mean lower profits, and in this case, higher interest rates, which also leads to reduced valuations. So growth stocks got hammered, coming in from two different sides. And then at the end of the year, the only reason I was fine with everything with this ratio going down till the end of the year, and the only thing I couldn't, come up with is that historically, the fourth quarter belongs to value. I mean, if you go back and look, not just this year, I'll give you an example. Transportation stocks, the dollar TRAN, that index has outperformed the S&P 500 during the month of November in 14 of the last 15 years. Not that it's gone up 14 of the last 15 years. It has outperformed the S&P 500. And of course, transports are part of industrials. Industrials are a little bit more value oriented. Little mixture of growth and value there. But anyway, I think seasonality may have had something to do with that. That was probably the one head scratcher throughout the last few years where I was like, okay, what's going on with some of the growth stocks here? But that's what I'm chalking up to. And now that we've had the massive recovery, I'm definitely agreeing with that. Now, let's see, we got manipulation. Actually, this is the XLY, XLP. Before we do this, again, I want to bring up another chart. I want to show you the QQQ. Remember I showed you on my Excel spreadsheet where I had looked at the SP or the QQQ versus the SPY, the relative, this is what I was looking at there. So this is, it says at SPY QQQ, that's just a name. It is actually the intraday rotation. This is ignoring gaps. Think of this as the AD version of the QQQ spider ratio. So, but it ignores gaps. So I came up with my own formula to look at the intraday movement of the QQQ versus the spider. And if the QQQ was doing better intraday than the spider, then this ratio goes up. If it was underperforming, it goes down. So look at what was happening during all the way to May of last year. It kept going down, meaning there was intraday distribution on the QQQ relative to the spider. But notice we went up in June, July, and August. Remember, we put the low in June that I called mid-June. This ratio was going in the other direction. Money was already starting to shift in a big way towards the more growth-oriented QQQ. Then we did come down again. That was that fourth quarter. We never took out the low from May, though, which was good. And then right at the beginning of January, we exploded. Look at where we are right now. We're back above where we were in November of 2021, or at least right back to that level. Forget about the August high. We've blown that away. Money is rotating so heavily into growth during the day. You'll never convince me that a recession is taking this market lower. You're never going to do it. Because I am seeing the money exploding. And so I'm just not going to buy into it. And while I've got the other charts down, I'm going to show you my other. This is the same chart except for the XLY XLP. So remember the XLY XLP in February and March was starting to turn down. And I said, yeah, this is one thing that's starting to bother me a little bit. Look at the intraday analysis. We went back down in the fourth quarter, nowhere near where we were in May. Again, think about all the manipulation that I was talking about. After May, we saw the morning gaps, we saw the morning selling, and then we saw buying the rest of the day. This chart does not include gaps. So it ignores that initial manipulation. And then this big move here, back to the upside, setting new highs. And then I will show you the XLY on a regular basis. Right here. So this is the XLY XLP. And so remember I said that we had gapped up, had a really strong move on the XLY XLP in January, but we started rolling over and that bothered me. Well, it did, but most of this is being created by gaps. That's why we're not seeing the same kind of ratio when we look at the intraday that I just showed you. Intraday, we are higher right now than we were in November of 21, or we were back up to that level. Remember, we were all the way back up here. But if we include gaps, it's showing that this ratio is really weak or that it continues to maybe be weak. That's not what we're seeing during the day. So what's happening is discretionary stocks are gapping down. Staples are pretty much just staying where they always stay, pretty close to even. And then during the day, when folks sell out of their discretionary stocks because the market's weak, Wall Street's buying throughout the day. They're buying the XLY and it's crushing the XLP during the trading day. So sometimes what you see on these charts is not what you get. So please, please, please consider all of this when you're thinking about your what you're going to do with your finances. And I sleep so much better and I trade so much more confidently with all this information that I use. And I listen to other folks occasionally, not very often, but there are a few that I do really respect that I just don't, some of them I just don't think have taken it to the level that I have. And I say all the time, and I'm not saying this to pat myself on the back, but nobody puts in more time to research stock market than I do. Nobody. I mean, if they do, wow. I mean, I'd like to shake their hand. like I said, who's writing articles on New Year's Eve at 7 o'clock at night? Probably not too many people unless they're a nerd like me. But I love it. I'm passionate about it. I mean, I'm passionate about family. I'm passionate about golf. I'm passionate about the stock market. And it's one of the things that drives me. If I wasn't doing this for all of our members and for the investing community at large, I'd still be doing it because I love it. And I would do it for my own stuff. I'm trying to learn more and more about the market every day, and it's not easy. So here's that XLY, XLP 3-year chart. So yeah, I mean, it's going up. There's that warning sign. Here's where we rotate back to staples. But again, a lot of this, especially after May, I mean, it's showing from May, we're back at where we were. This includes the gaps. We're way, way above if we look just at intraday action. So anyhow, I think this information is really good. Aaron, if you could, why don't you bring up, before I go into the sentiment, I just want to make sure everybody's aware of the special that we're doing. We always have these webinar specials. And so I want to make sure that we're able, I mean, I guess maybe if we have it at the website, maybe I could get into it. I don't want to lose my place. So if you are there, all right, let me go back then. I should be able to find it. Earnings beats, let's go here. Okay, so on the home page, if you're looking for it, just go to earningsbeats.com. We do have it on our home page. So here's what we got. First of all, we offer you a 30-day free trial. You have to give a credit card, but we are not going to charge you if you don't want the service. So you get a free 30-day trial, or if you'd like, you can jump right in. I mean, I think we'd have a lot of members that would probably be suggesting to you to take out this membership. It's well worth it. $997 for a year. Normally we charge $147 a month. So you can kind of get an idea. If you'd spread that out, 147, let's just call it 150. 12 months would be 1,800. 14 months would be 2,100. We're going to give you 14 months, our regular 12 months plus 2 bonus months for $997. 14 months for $997 instead of $2,100, $997. So you're more than 50% off the monthly rate. I mean, that's just so that you can get in and experience all we have to offer. I think you'll love our service. If you want to try us out, you got a 30-day free trial. You can do that. I think this is going to end next week sometime. I think we have maybe a week that we'll keep this webinar special up. So I'll give you a little bit of time to check us out if you'd like. But I think, again, I think you'll enjoy our approach. I think it'll be a refreshing approach. It's going to be different in many ways than a lot of services that you probably have subscribed to in the past or have considered. We are not just a stock trading service. We'll give out a lot of setups. We educate. I'm not registered investment advisors. I will never say that I'm advising you to buy this or that I am recommending this. All of our members have different risk tolerance levels. It would be so irresponsible for us or any service to say, here, buy this. Unless you're a registered investment advisor, you're not licensed to do that. Instead, what we do is we educate. I might say, hey, I like Apple. This is why I like Apple. And then you can decide if you like Apple based on what I'm suggesting or what I'm looking at. You might disagree with me. And you know what? You might be right. I can promise you, I get a lot of trades wrong. But you've got to manage your risk to the downside. And many times you can let those winners go. So if you can, for me, if I'm 60% right on my individual stock trades, I'm going to have a really good year. If I'm 50%, I'm going to have a good year because I'm normally going to make more than I'm going to lose on a trade. If I'm at 60% or higher, it's going to be a banner year. And with all the manipulation stuff that we've talked about, I think you've got opportunities to make, do pretty well in the stock market. All right. So anyway, I just wanted to point that out. That will be going on, I think, probably for about a week. If you have any questions about this whatsoever, be sure to write into us at support@earningsbeats.com. Plural and plural. Earnings beats. I get a lot of folks earning beat, earnings beat, earning beats. No, both plural, earningsbeats.com. And again, write in. We're usually very quick on response. We've got a very, very strong customer service department. Hats off to both Matt Townsend and also to my daughter, Erin, who will back up from time to time there. They usually get back to you very, very quickly. And so if you have questions about our service or about this special or whatever, feel free to reach out. All right, we are going to move back into the final, well, the most significant final segment, I would say. I will be giving my forecast here in just a little bit, but I do want to walk you through sentiment because sentiment is a big part of the market. I'm going to start off with the equity only put call ratio. Now, if you want to get this, you can get this. Actually, you could go over here and go to cboe.com. So I'll show you how you can get to the data. So if you go to data, click on data, come down here to market statistics, and then click on over here under US options, go to market volume. Every day, they will give you total puts versus calls, index options, put versus calls, and then equity options, put versus calls. And they break it down for you by half hour. Now, I'm showing this. I want to show you this detail for a reason, because back in November and December, there were some crazy put readings that were coming in the middle of the day. I mean, you can kind of see how this is pretty uniform. You get more volume beginning of the day and the end of the day, and you go through the lunch hour and you can see the puts. This half hour went up 100,000, 98,000 here. This one went up 94,000. This one here goes up 98,000. Then here we went up 114,000. That's normally what you see. We had about 10 days, maybe 14 days. I don't know how many days it was back in October and November of 2022, where all of a sudden the puts would be doing this and you would go from 799,000. Next reading would be 1.2 million. Then you'd have 2 million and then 2.3 million. And I'm just like, whoa. And calls would just be the same, just going up slightly. And so a lot of these crazy number of puts were going in the middle of the day, and they were shooting the equity only put call ratio up to levels I've never seen before. And they were doing it on days when the market was going up, which made no sense because normally folks start buying more and more puts when the market is selling off. And so you look at what you're looking for is the kitchen sink to be thrown in by those in the options world. That's why I look at equity only. Index options, you get a lot of institutions that will trade index options. Equity options, you're not normally going to go into individual equities and buy lots and lots of puts. Not institutional managers don't do that for the most part. Well, in 2022, they did it for the first time since I've never seen it before. And it was throwing off the readings. Like significantly throwing off the readings. So I want to show you, this was the readings, and this comes straight from stock charts. And by the way, their daily readings always tend to be lower than what's coming over from the CBOE. I've asked them. I know they're looking into it. I haven't had an answer, so I don't have an answer for you. But I don't understand why this ratio isn't exactly what we see over at the CBOE, because it says it's the CBOE options equity only put call ratio, but that's not what the end of the day shows over there. Like here we're showing 0.65 is the close for yesterday. And if I look over here, it's 0.85. And that's about the difference. It seems like it's about 20 points lower. 15 to 20 is what I normally see. And I don't know why, but it's fairly consistent. So I still feel comfortable using this data and these charts. But anyway, these are the readings I was talking about in November and December, where all of a sudden we were getting these massive readings, 2.4. I can tell you that during the financial crisis, the highest equity only put call ratio reading we ever had was 1.35. That was extreme fear and panic. And here we had 2.4, and it was actually at the end of December. I think the market went up that day. And so it made no sense. But anyway, it looks like maybe there's about 10 of these days. I went back and created a user-defined index at Stock Charts, and I put all the data in for the CPCE, equity only put call ratio, except these crazy days. I went back and adjusted them to what would have been a much more reasonable level. Because there were articles out talking about how many professional investors, not retail traders, but professional investors were putting on lots of equity puts, like hundreds of thousands of equity puts. And that was accounting for these crazy readings. But I'm trying to get a gauge of what's going on, like with you and me, individual traders, retail traders, and taking into account what professionals are doing is kind of going against everything that this chart stands for and all the research I'm doing. So I needed to adjust that out. But any reading you have from Stock Charts on the equity only put call ratio is going to factor in these elevated or inflated readings. Mine will adjust for them and take them out. So just wanted to show you. So here, when we started 2022, you can see the equity only put call ratio was down here, ridiculous levels, ridiculously low, which means there are a lot of calls being traded relative to puts, meaning that everybody is bullish. And when everybody gets bullish, what happens? The market goes down. So I said at the beginning of 2022, we needed to reset the sentiment. Sentiment was way too bullish. We needed to get people fearful. And so the market went down first 5.5 months of the year. And then you see May, June, even, later in the year, this is where all the fear and panic is coming in. Why? Well, now we've got rates going up. We've got the Fed that's hawkish. We already had inflation. Now we got recession fears. And so everybody is still remaining very fearful during all the way through the end of last year. The market bottomed in June. I mean, we had that one little move lower in October, but basically that June low was the low. But look at when all the fear starts building after the low. Why is that? Why wouldn't the fear be in here back when the market topped? Why? Because nobody calls market tops. They're looking for the market to be their ATM machine and keep going up. So I said, we need sentiment to get really bearish. Unfortunately, I said a lot of people are going to lose a lot of money until they learn lessons like I learned back in 1987 when I got hammered, to a lesser degree, maybe in 2000. 2007 to 2009, I didn't get hurt very bad personally. And the last couple, not at all. I mean, you can kind of see them coming, but you just don't, they're not going to last to the downside. So it gives you some opportunities to make some money from the bottoms. But anyway, this is the sentiment starting to get more and more and more bearish throughout the second half of last year. But once you start getting everybody piling in, that's when the stock market stops going down. Next chart here. This is my CPCE. So notice the November and December readings are starting to come back down. So remember, over here, we had all these crazy readings. And so it looked like the sentiment just kept getting more and more bearish. But again, if we go and we look at my chart, it actually, we were probably still up there until the beginning of this year. And I think we have now started to roll over. And I think we're coming back down. And that's really good news for the market. And I'll show you why in just a minute. But before I do, I want to talk about the next chart on the sentiment. This is what I call the speedboat chart. This is a 5-day moving average of the equity only put call ratio. And this, it helps to predict more short-term to intermediate term market bottoms. Pretty significant, but maybe not major. market bottoms. Anyhow, when you see this reading for 5 days go above 0.8, that is normally going to coincide with a bounce in the market. And so I just drew all of these vertical black dotted lines. Anytime this reading goes through 0.80, I can see like there are a couple maybe I missed, but essentially this one right here I could have hit. But when you look at it, look at what the stock market does almost every time after the readings come in. Almost every single time the market goes up. So while everybody else gets bearish, if 4 months from now the market's much higher and we go through a period where we lose ground for 5, 6, 7, 8, 10 days, and the market pulls back and you start hearing all the media come out again, and you see this 5-day moving average shoot back up near 0.80, get ready, because we're about to put in a major bottom. That's a really powerful signal for short-term traders. Again, these are speedboat signals. Speedboats can kind of move up and down, left and right pretty quick, zig in, zig out, whatever. So this one is just giving us short-term calls, and I think very, very accurate calls. Now, if I just look at the last year and I look at that 0.8 reading, the thick vertical black dotted lines show you just as we're hitting 0.80, and look at where we were on the S&P 500 right here in March. Boom. Here at the end of December. Boom. Here we went just a tad lower when we peaked, which probably was a few days later. Pretty much bottomed. We did come back down one more time to this bottom. And then back in June, right at the bottom. That was one of the factors I talked about when I called the bottom, was that the market had gotten so fearful. We were finally seeing sentiment start to reset. I had been saying all along we needed readings to 0.75 or 0.80 on this 5-day moving average before we could even think about a market bottom. And I can tell you that in this century, every major market bottom, every single one, has seen an equity-only put-call ratio, 5-day moving average of at least 0.75. So when we were going down back in February, March, and April, I mean, here at this low in April, we had a 5-day moving average, got up 0.725. In May, we were getting up to 0.75. And I actually wrote articles, did videos, and said, we're approaching a bottom. And then it was this move right here when I said the bottom is in. Because we needed everybody to feel like the market has no hope. And that has only continued. The market has bounced, but the fear level and the despair, everybody I talk to, all my friends say, why do you think the stock market's going up? Look at all the problems we got. My gosh, inflation, still high, and we got interest rates going up, and, we're going to have a recession. We're starting to see some things slow down. I'm like, yep. I agree with all those. And you know what? Market priced it in. We just had a 28% drop in the S&P 500. We had almost a 40% drop in the NASDAQ 100. Why do you think we dropped? The stock market doesn't price it in as it's happening. It prices it in advance. So, but this gives us the CPCE gives us some really good signals in the short term. Now, I don't always use it for tops, but notice where the tops are on the S&P. Top here, major top, that was the low on a 5-day. Look at this top right here. Look at this low. I mean, there was a low there. We had a little bit of a top, but then we went back up. I don't really use the lows. I don't find them nearly as successful in calling market tops. I think you need to look at rotation to really to think about doing that. And let's go on to so this is my Freightliner equity only put call ratio. Here's the Freightliner. So the Freightliner is the CPCE 253-day moving average. Why 253 days? That's 1 year. It gives you a ample time for things to really reset. And when I started looking at this and I started plotting it, I found something really interesting. And that is when this rolls over, when this Freightliner, this is a Freightliner, this isn't a speedboat. It doesn't go up and down and up and down and up and down and up and down a lot. When it moves and it turns, you'll know, and you better pay attention, because here we turn down, the S&P 500 goes up 20%. Here we go up. The stock market lost 50% during that run. Here, while sentiment was resetting to the downside, the market went up 101% over 2 years. Here, while the sentiment was resetting back higher, things were getting more fearful. Over that period, S&P did nothing. Looks like went down 4.4%. Then we roll over. We started getting a little bit more complacent as the market started to get more bullish, 56% higher. Then we roll over. We start going up. For 2 years, we went nowhere. Then we come down here in 2016 through 2018, up 47% over 2 years. This period right in here with the trade war and the pandemic and there was a lot going on. And this was like the Freightliner was trying to be a speedboat. And it gave us some really not so great signals. I mean, individually, the signals were right. But if I was pointing here, I would have been thinking, okay, it's going to keep going up for a while. And it didn't. It rolled back over. And when it rolled over, the market went up. And then we rolled back to the upside, market went down. And then we came back down, and that's when the market had its huge run to the upside. But I would say this was the biggest chart that I pointed out back at the beginning of 2022 at Market Vision 2022 event. I said, folks, we are coming out of a very, very complacent period for stock market. If you look historically, we've never seen the stock market so heavily bullish, the sentiment so bullish. Look at all of these other bottoms. The 1 year moving average. Previously, we didn't even have many readings down around 0.5 or 0.46. Here, we had a year's worth, an average. It was so bullish. We ran out of buyers. Like I said, look at this. 22-month run, 112%. At the high, I think it was 115%. The highest 22-month run we've seen since the 1930s. And with that, everybody was bullish. Everybody poured everything they had into the market. And so when this turned and started going up, well, this is where we are right now. We've lost 12%, but I think we're getting close to the high. Now, keep in mind, this is based on those high readings in November and December that should not have been included. So when I strip them out, you can see we're still going higher, but now we're at 0.685. And on this one over here, we were at 0.72 basically. So the reading really wouldn't be quite as high. It's smoothing out, and I think getting ready to roll over. I think it was very similar, starting to look a little similar to 2009. And I mean, the bottoms don't always come in like here. Notice the sentiment rolled over after the bottom had come in. So it came in after we had already started up to the upside. So it doesn't always come in right at a bottom. Sometimes it lines up pretty nicely, like back here, 2009. But sometimes we don't, here we had a bottom in 2011. Well, we didn't roll over until middle of 2012, but we were already in an uptrend. I think we're already in an uptrend. And I think we're going to get this to roll over. And when we do, I think we're going to have another one of these big periods. I don't think it's going to be 112% over a couple of years, but I wouldn't be surprised to see a 40, 50% move over the next 2 years based on this rolling over. And again, it's because everybody is already out that wants to get out. People are shorting. They're borrowing to sell. When this all turns back to the upside and is on course, I think you're going to see a very, very big rally. And like I said, I think it could be happening now. The last thing I want to talk about with sentiment is the VIX. I don't want to spend much time on this, but this is what I'll say. Everybody's looking for the VIX to go back up again. Here in 2002 to 2003, we went down. And notice when we put in the final low, early 2020 or 2003, not quite a new low, but pretty close, double bottom. Notice that look at where the VIX was. The VIX starts going down. We start losing fear in the VIX. And if you don't understand what the VIX is, it's a volatility index. And it's calculated, it's the expected future volatility in the market. And if you know anything about volatility, normally volatility means the market is going lower. When the market goes down, volatility index goes up. When the market goes up, the VIX goes down. The volatility index goes down. So you usually have that inverse relationship. So when you look, here we go, we're going down. Look at the VIX going up. But notice right at the bottom, it looked like we're getting ready to break down. Even on this final low right here, the VIX had already started coming down. And then we went back and retested it. We were much, much lower. Look at 2007 to 2009. All the way into the beginning of the fourth quarter when we were going down, you can see the VIX shot up to 90, the highest I've ever seen. But look over the next 3 months as we went down further, we started losing the fear. The fear and the panic had come out of the market. And so a falling VIX with a falling S&P is a pretty good signal that the market has bottomed. And so look at this move here. We went down, and as we were going down, the VIX was going down. Here we went down, VIX spiked, but then by the time we hit the final low, the VIX was going down. Look at 2015, 2016. There was a new low. Looked like we were rolling over and breaking down. Look where the VIX readings were, 50s, and then it was down in the 30s. These other bear markets, they went so fast, 3 months here, 1 month really in 2020, that it really did, the VIX didn't give us any signals. And then here, look at this. We started in 2022 going down, the VIX was rising. And then about right around April or so, as we kept putting in new lows, the VIX started going back down. And I've been talking about it, saying that the VIX, the lower the VIX gets, the less fear that's in the market. Last thing I'll point out here is that when you're in a secular bear market, a long-term bear market, the VIX always stays above roughly around that 17 level. Every time we have any kind of a bounce, market goes up and the VIX falls back, we hold 17. That's my point. Here we started bouncing, or we had a couple of bounces in 2008. And when we did, the VIX never went below 17. Even into 2010, I mean, we started maybe in 2011, finally getting below. And that was telling us we were basically out of this secular bear market drop. When we get down below 20 or 17 here in 2004, even though we're not at the high yet, even though over here we're not at the high yet, the VIX is breaking down both times. Look at where we are right now. VIX closed Friday at 1707. Watch the VIX. This is another really important component of the market to watch. History tells us if this keeps going down, this bear market, we ain't going to another low. And that would also line up with everything else I've talked about today for the most part. I mean, honestly, when I look on the bearish side of things, I see a couple of things. I mean, I see the XLY versus XLP, the one that included the gaps going lower. Okay, that bothers me a little bit, but when I go to the intraday and I strip out the gaps, it's manipulation. The XLY versus the XLP intraday is soaring. So I'm not paying any attention to that. I think that easily can be explained. Then I look at on a weekly chart on the S&P 500, if we go all the way back to the beginning of what I was going over, you will see that on this weekly chart, lower low, lower high, lower low, lower high, lower low. Excuse me, we haven't taken out that high yet. We need to get through 4,300. So from a technical perspective, if somebody said, Tom, we're downtrending, we have lower lows and lower highs on the weekly chart, I would look at them and I'd say, you are absolutely right. And so from a technical perspective, the problem I have is, so if we go up and we take out 4,300, is that when you're getting in? Because we were at 3491. You just missed 800 points on the rally. I mean, so, okay, technically we make that break and now, okay, let's have a celebration because now we're confirming it's over, but now you're going to get in. So that's my problem. Yes, technically it's like, hey, if you want to follow the definition of every rule, go right ahead. If you want to ignore every possible signal that I have just gone over today, because by definition, we're still in a downtrend, feel free. I'm not going to stop you. I'm trying to give everybody something to think about, to consider, and hopefully understand. The third thing that I would say, and this is probably one of the bigger ones, is the banks. Now, we had a big day on Friday. We're starting to rebound a little bit. You know, banks on a relative basis are at their lowest level, even lower than 2008 during the financial crisis. Banks have not performed well in this rally since 2008. They've kind of just gone along, not even kept pace with the S&P 500. So that's a little bit of a problem, because I do think banks need to be healthy. I don't ever look for banks to lead the market, but I like for them to at least be somewhat healthy, because we're such a debt-driven society. If they start to cut off lending, that's not going to be good. And that a lot of times will lead to a recession. So that's going to be maybe the news item that I will personally be watching, just kind of not really the news, but maybe just how the banks are performing, watching their charts and looking at what? The AD line, because are they gapping down or are they actually selling off? It's a big difference. All right. That is what I wanted to go over. I wanted to give you my forecast now. Now, let's try it again. I'm going to give you my forecast now. And this is what my forecast was, Market Vision 2023, back on January 7th. That's when we had this. And this is the chart I pulled up. And I said, okay, here we are going down. I thought in 2022, we were going to go down to about the 3,500 to 3,800 range. That was what I said was worst case scenario. Okay, if you really want to nitpick, I missed it. We got to 3,491. We went 9 points below 3,500. But that was the range that I gave back all the way in January of 2022. I said, worst case, I said, the market's scary here for me right now. Time to be cautionary. Let's see if we get breakdowns to confirm. But we got a lot of warning signs, and this is worst case scenario. And I even drew the chart just like I did for 2023. I had a line coming straight down here first half of the year, and then right back up. I thought we would come, and we did through the latter part of August. And then I won't get into that. Fed Chief Powell, that was the Jackson Hole speech. More pain ahead. Thank you so much, Mr. Fed. Anyway, after that, though, we did struggle some more. We did put a slightly lower low in, and then we rallied back. I think overall my 2022 call was a pretty good one. Actually pretty spectacular. And 2023, what I thought would happen, I said, I think we're going to have a strong January. And I pointed to maybe getting up close to 4,100. I think we had closed 3,800 or something like that before. And then I thought from there, we would have a little bit of a struggle, as we worked our way the rest of the first quarter. And again, remember back to what I broke down for everybody on that quarterly performance. Do you remember that? Where January through February 15th, very bullish. February 15th to March 31st, not nearly as bullish. So part of it is just recognizing and understanding how the market typically works. I'm trying to combine everything: the sentiment, the seasonality, historical tendencies, the manipulation taking place, history, all of these different things to try to give perspective, all the rotation that we talked about, divergences. I mean, everything goes into play as we try to make these calls. But anyway, we got back up to earlier this year. I said we were going to get back up to 4,100 in January or close to it. We actually moved into early February. By the end of January, we were almost to 4,100. Beginning of February, we went just over 4,100. Actually, we had a big move there, almost 4,200. And by mid-February, we were still kind of holding in. Let me pull up another chart here. So you can kind of see what I was talking about. So I thought we'd get to 4,100. If you look, here was the move. There's 4,100 right in here. And that was your January move. And then we had a little bit more to February up to 4,200. Look at where we were in mid-February. That was a really nice January to mid-February, wasn't it? What about starting in mid-February? Had a little ABC correction. Well, actually, not really, because it would be off the top. But we had a move down, a rebound, another move down. This all occurred during that period where we don't usually see a lot of market strength. By the end of March, we had moved back up, but the second half, we really didn't do much overall. And so that's kind of what I was looking for. Move up, a move down. I think I showed 3,800. We got down to 3,808 and then back up again. So keep in mind that this move up here and this move back down to 3,800, these lines were drawn in January. And then from there, I said going into to the rest of the first half of the year, I was looking for a big rally. Summertime months, August and September, can be a little bit rough. I don't know. We might run into a period where we get a couple of inflation reports that look like, oh my gosh, maybe we're getting back into inflation. Or maybe the Fed says, you know, we're going to have to keep watching, might have to hike rates again. Like, I don't know what could happen, but I could see maybe a pullback late summer. And then I think fourth quarter, like I showed you, first half of the fourth quarter, October 1st to November 15th is strong. Second half strong as well. I think we're going to soar into the end of the year. So my forecast really hasn't changed. I'm still, you know, when I look at the market, I mean, this is what I kind of looked at, going down, going up, coming down, then going back up. Well, maybe we're going back up a little bit earlier than what this line shows, but basically we're following that. And I think we're going to make a big run into the end of the year. I said back in January, I think my target level was 4,700, I believe, and I'm going to stick with that. I don't know that we get all the way back up here. I think it's possible we could break to a new all-time high by the end of this year. But I think it's probably more likely we do that beginning of next year and we just get close this year. We'll see. But that's my forecast. Those are the reasons why. Hopefully you learned a lot from this session, and I'll be happy to answer questions. Actually, John, if you could give me these questions in about 60 seconds. I don't know if anybody else needs a bathroom break or something.
Sure.
But I'll be right back.
Yeah, go ahead. Okay, let me mention one thing. You know, we got a lot of questions during the event. I was able to answer quite a few of them. We're not going to be able to get to all of them. We would literally be here, you know, for a couple more hours. You guys have been fantastic. So if for some reason we don't get to a question you asked and it's really important to you, you can send an email to support@earningsbeats.com, and we'll do our best to get back to you. But it's just, like I said, so many questions come in. There's a lot of people here. And let me tell you a question that kept coming up pretty frequently. Were questions specifically about maybe a specific event or a specific item. For example, you know, how does Tom look at inflation? How does he look at the US dollar? How does he look at you know, international problems, that kind of thing? And my answer was always the same, and Tom's would be the same, is that he's really looking specifically at the charts, because our theory, which has been in the theory of technical analysis, is that everything that's going on around you makes up the chart. It's like looking at an X-ray. A doctor looking at an X-ray of somebody and coming to a conclusion of all the things that are going on in the body. In the case of technical analysis, you know, don't you think that the market was already reacting to the potential of the Fed raising rates? For example, we got that low in October, and now they're knowing that the Fed is towards the end of raising rates, and we're seeing the market starting to solidify. So the answer to a lot of your questions about specific things that might be occurring these are all part of the analysis of looking at the charts, which really takes pretty much everything into consideration. Okay, so let me get into a couple of specific questions, Tom. Let's see. All right, that's a world event one. We had some questions about the put call ratio. Hold on.
Yeah, if it's a world
All right,
event,
what would be the number to watch on stock charts for the CPCE to top and to expect the bounce, since we don't have your manual equity put call ratio?
well, I mean, if you look at, I don't know which one this question's referring to, because I use that speedboat 5-day moving average, and I have the Freightliner, which is the 253-day moving average. I mean, I think on the problem with the longer term, it's going to take a little while longer to roll over because some of those readings were high. I mean, they were only on 10 different days. But I'm anticipating, based on my schedule, that we're going to start to roll over. Let me go back to one of the charts and see if I can find the one that you need so that we can kind of look at this together. Okay, so these are my readings. So this is the user defined ratio that I used. Or not ratio, but user defined CPCE. And so this one doesn't have all those crazy high readings. But what I'm looking at is I'm seeing all of this coming down. The reason why we're not seeing this roll over yet is because even though the market went down through May of last year, fear didn't really pick up and get to the level where we need it to start falling off until like May or June of last year. This is when all the readings, it was actually second half of April. Remember, we had that big decline all the way through to May 20th or whatever. When that occurred, that's when we started to get some really consistent high readings up near this 0.80 level. Remember, I showed you that was when we finally hit the 5-day moving average of the CPC at 0.80. And so that's when it starts alerting me that, hey, okay, now we're finally getting somewhere in terms of sentiment. Now, the problem is that during this year, people were still bearish. They're still somewhat bearish. It's starting, I can kind of see it starting to come back down again, but they're still bearish enough where all of the readings leading up to April 15th, look at these readings at the end of March and early April. Remember, we had that big run at the end of March to the upside. I think it was fueled by short covering and by equity only put call ratio, or not equity only put call ratio, but the max pain for options expiring that month. We had a big rally into the end of March, and that sent this way down. So all of these March readings that we were getting, when you get a new reading here, the old reading a year ago drops off. Well, we were dropping off low readings and still adding higher readings. That's what sends that 253-day moving average moving higher. What's about to happen is we're going to start replacing these late April and May readings, which are up in the 0.7 to 0.8 area, maybe even as high as 0.85, 0.87. And now we're starting, you can see we're starting to kind of get most of the readings now in the 0.6 to 0.7 area, maybe as high as 0.75. So I think what's going to happen is over the next 4 to 6 weeks, we're going to start to see that top. So if we're seeing that and we start getting price breakouts on the S&P 500, I think we are good to go. So I think the 253-day moving average you'll probably start to see rolling over within the next 4 to 6 weeks. And so if this market, in my opinion, if this market has any chance of going lower again, it better be happening really soon.
Okay, given you're a CPA, do you ever match technicals with fundamentals?
That's what we do. I think it's a unique service because a lot of the research, I mean, I showed you research in some of the stuff I did in trying to interpret the big picture, the overall picture. Most of our research is putting together chart lists for members. We have our strong earnings chart list. I think that's our flagship product. It is for me. in terms of what I use. And what that is it's a chart list that right now probably has 400 or 500 companies on it. They all beat Wall Street estimates last quarter as to both revenue and earnings. Had to beat both. If they beat one, match the other. Even if they said, hey, we beat revenues, we matched earnings per share, and we're raising guidance. Nope, not good enough. It's got to beat. Management needs to beat estimates. I mean, if you understand valuations, future growth rates are based on management achieving their goals. It's kind of a basic premise in valuating any company. So I want companies that beat expectations. Now, some companies do it more than others, but what we do is we put them on our chart list once they've beaten, and they stay on there for up to 3 months until they are ready to report their next earnings. Then we take them off. When their earnings come out, if they beat them again, we put them back on, and then we go again. That's round and round. It's just almost like a, what you want to call it, like a revolving door. You know, we got companies coming in because they just beat, and we got companies going off because they're getting ready to report again. So it's just this revolving door of companies, fundamentally based. I look at technicals. I want to make sure I see something technically that I like. It could be a really strong AD line. It could be that the company is one of the leaders in its space. It could be that maybe it's not one of the leaders in its space. Maybe it's a laggard, but the space is red hot. You know, I might look at semiconductors and say, wow, this group is really hot. This is not one of the best stocks within semiconductors, but it's still doing well. It's just in the hottest sector. So if you're not outperforming NVIDIA or some of the other big names, then, you know, it comes across and looks like you're a laggard. But really, it's the combination of those two, both technicals and fundamentals, that puts together that chart list. And then we'll have another chart list for raised guidance. And we'll have another chart list for companies that are performing really well technically, but didn't beat their earnings. So in other words, these stocks are showing a lot of technical strength, but they didn't beat their earnings or revenues in the prior quarter. Then we have strong AD. Any companies that have AD lines that are really strong, we put them into a chart list. So yeah, we're combining all of this stuff into the research we do for our members.
Somebody asking about market bottoms. Does the market bottom coincide? He's saying touchdowns. I think he means touching to weekly 200-day moving average. It has done it the past 10 years.
Well, first thing I would say is I don't have a 200-day moving average on my charts. I don't use it. For me, I've just found it to be worthless. I mean, I'm a momentum trader, and by the time prices get back to their 200-day moving average, I've been long gone on that stock. I mean, or index or whatever. The 200-day moving average, I mean, maybe it served a purpose for 10 years. Has it served a purpose for 80 years or 70 years? Because I would probably take it back and look. I don't know. Some technicians use it and they use it a lot. I am just one that doesn't use it. I mean, everybody has their own preference. So I ignore it. You hardly will ever see the 200-day on one of my charts.
Okay, hold on. Somebody who's asking about, okay. Tom, I'm out of the TQQQ. Is it a good time to jump into the TQQQ?
No, I wouldn't be adding anything at this point. And this is a little bit more of our service. This is just something that we've been talking about throughout this year. And I've spent a great deal of time talking about leverage and how I use leverage because I have been in the QQQ. But if I think we get to a really interesting level where I believe we're going to take off from, then I will switch out some of my QQQ and I'll get more aggressive either in the QLD, which tracks the QQQ at 2 times, or the TQQQ, which tracks the QQQ 3 times. You just have to be careful with leverage. They do erode over time. So if you're holding them and you're riding them up, you're riding them down, you're riding them up, you're riding them down, then they're not going to produce the 3 times results that you're looking for. And the more volatile the index is, I mean, I can only imagine, like for some other areas, maybe some of the precious metals or something, you know, if you get into a triple with that, or the semiconductors or something that really does a lot of really fast moving. It's great playing these juiced or leveraged ETFs when you're moving with the trend. but if they go against you, they can really ruin your portfolio. So I tend to just play them from time to time. Right now, the problem I have, I mean, I'll just pull up the QQQ. But the problem I have here is the QQQ is up near resistance. I mean, I think it's going to break out. I believe it's going to break out, but this isn't where I want to start getting into a leverage. I mean, just a normal pullback again to the 20-day, and I'll be down $7 on the QQQ and probably, who knows, what, 6%, 7% on my TQQQ. You know, and then I would just rather like on a 20-day test here, we had to move up, clear overhead resistance, 312-ish, 311, 312. We broke out and we just went down to the 20-day moving average and close to that price. I mean, as you get down to those kinds of levels, that's when I would think about the TQQQ, not when you're up challenging resistance. Now, if we got a breakout, that would be, I mean, if you're thinking, okay, we're breaking out and we're going to run, by all means. But if we fail to hold the breakout, I would be right back out. I don't hold these things and wait to see whether or not I'm right or wrong in 2 weeks. These things can go against you. And especially if you're, you know, so much into leverage, like if you had your whole account in, say, the QQQ or the Spider, and you pull out 20%, and you put that full 20% into something like the TQQQ, you now have more money at risk than what's actually in your account without having to go into margin, by the way, which is kind of a nice thing. But if you lose, you're going to start losing more than your fair share, if you know what I mean. So I picked my spots with leverage, and I'll just leave it at that. I'll be talking more about that as we go forward.
All right. We got to wrap this thing up. A couple of things that a few people have asked: is the session recorded? Yes, absolutely. If it's not today, you'll have it, you know, by tomorrow. I'm pretty certain of that. Also, a couple of members one member saying that being new, there's so much information. You know, could we give some tips on what to key on? I have a couple of thoughts, and maybe you do too. The one thing I'll say, first of all, is the daily market report. It just has a ton of information, the macro market. Tom has sector information. He'll have stock trading information, lays out when companies reporting earnings and that type of thing. So the daily market report, necessity for macro and even some trading type ideas. The strong earnings chart list, which you'll find easily enough in our chart list section, which contains all the companies that beat both top and bottom line and could be good trading opportunities. And there are a number of other lists in there that you should just look at, just read what they're about and make a decision if there are stocks that you might want to, you know, consider pursuing. And then we have a tremendous webinar library. This is a lengthy one today because of the content, but we just have tons of webinar educational videos that really cover every topic. And then the last thing I'll say is that coming up next week, Tuesday, and this is a members only, you have to be a trial member or full member, our Max Payne event, one of my favorites, and favorites of the each month, where we look at the third Tuesday of each month before monthly expiration. I know there are weekly option expirations. We focus on the monthlies, where Tom talks about the major indexes and some individual stocks that could make significant moves over the week or so from the Tuesday that we have the session. And prior to that, you get a list. Aaron puts a list together of Max Payne stocks that shows where the market makers would like these stocks to end up by options expiration. It's fantastic information. You know, I found it to be extremely useful even in my own trading. So, Tom, those are a couple of things that I really think are important. I don't know if you want to add to that.
Yeah, well, as soon as you asked the question, first thing hit me was the daily market report. I mean, that's kind of the flagship. There's even an executive area where we put like 10, 12 bullets at the top. So, I mean, if you're really busy, and you could get the email and literally read those bullets in 30, well, maybe 60 seconds and kind of get a quick feel for what's going on in the market and kind of go back to your work or whatever. So we have that for those who are really busy at work. But I would say the only thing I would add is, we really try to zero in with all of our chart lists. We try to zero in on some of the best trading candidates. And when you have a strong earnings chart list that features, like John said, top and bottom line companies that beat on those levels, and then you've got strong future earners, which are the ones that didn't meet the strong earnings because they missed estimates, but they still look good technically. Some people will say, well, if you're only looking at the companies that have beaten, and aren't you missing out on some other companies that might be doing really well? And the answer is yes. And so basically that's where those companies go. And then you've got the strong AD, accumulation distribution, which I think is massive, and the raised guidance chart list, which gives you all the companies that have either raised revenue or earnings per share guidance. And finally, the one thing I want to mention is we have another chart list, which is our bullish trifecta. Any company that beats its top and bottom line, so it's in the strong earnings chart list, raises guidance, so it's in the raised guidance chart list, and also appears to be under accumulation, so it's in the strong AD chart list. Any company that is in each of those three go into our bullish trifecta chart list. And right now there's only like 80 companies, 80 or 83, something like that. And I happen to think these are some of the best companies to trade. And with that, I just want to mention we have scanning strategies on our website. And I think going in, they're generally pretty easy scans to follow, not getting into anything that's too crazy. And I think if you apply those scans against the various chart lists that we have, especially that bullish trifecta chart list, I think you can come up with some tremendous opportunities for trade. So I would leave it at that.
Okay. And last couple, we'll wrap it up here. Somebody's asking when's the model ETF webinar? That'll be the 19th coming up. And I'll tell you something, we've actually, especially of late, like our ETF portfolios, I think have done pretty darn well against the market. Those are also very interesting. You have to be a member. Again, you can be a trial member to participate in that. And then it's last question, you plan on doing any more annual member benefits like the trading day seminar? I think we're talking about another trading day seminar, right, Tom? A live trading seminar at some point soon?
Yeah, I think we're going to do one in May.
Okay.
That would be an annual membership. You have to be an annual member. I mean, it's taking a lot more time out. I mean, I stay pretty busy throughout the day, and not just on my own trading. I'm talking about for all the research and stuff that I do for earnings beats. A lot of times I don't even look at the market until I'm ready to start writing the daily market report, because I'm trying to keep up with all the different products that we offer our members. But yes, I think that doing another session, I don't know that it'll be an all-day session. It might be one of these where maybe we meet for a couple hours in the morning and then come back and meet for a couple hours in the afternoon, because I think the middle of the day kind of gets a little dry. So maybe something like that. But yeah, definitely going to be some more news coming out on that front for sure.
Yeah. All right. Let's go ahead and wrap up again. So many questions. We got to a lot of them. If something's really pressing, send an email to support@earningsbeats.com. We'll do our best to get to you. In the meantime, again, go to our webinar, our site, webinar special, take out the 30-day trial, or the annual membership gets you a 2-month bonus. So you're getting 14 months. If you sign up for a trial membership, and then by next Friday, you sign up for the annual special, you end up with 15 months. It's just, I don't know. I think it's a great way to save a lot of money and to have us on your team for the next, 4 or 5 quarters. So hopefully you'll take advantage of that. That's it for me, Tom.
Yeah, I just wanted to point out anyone who wants to know, if you go to earningsbeats.com, right there at the top, webinar special, you click on it, and then you can see the different options. And like John said, if you have any questions, simply reach out to us at support@earningsbeats.com. We'll get back to you quickly, and we'll get you set up. Anyhow, that's it for me as well. I hope you enjoyed the session. I love doing these sessions, not just for you all, but it actually is a great refresher for me. It forces me to go in and look at all these different charts that I have been constructing for many years, and have really helped in terms of guiding us through some rough markets, a lot of turmoil. And I don't know that the turmoil, the news has ended yet, by the way. I think we're going to continue to see more and more. I think it'll be recession talk. I wouldn't be shocked to see deflationary talk coming down the road. We'll see what happens with that. But anyway, have a great day. I'll keep you all up to date and posted, especially through that daily market report. So if you haven't tried us, this would be a great 30 days to give it some thought. Have a great day, everybody. Happy trading.